morning. I'm Julie Hyman with Brad Smith and Brian Sazzi. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know, interest rates are likely to keep moving higher, and that is spooking the markets. Goldman Sachs is expecting the Federal Reserve to raise rates another 3 times this year. Bank of America chiming in as well this morning, saying the same thing, each of those raises by 0.25%. Wall Street, in fact, more broadly is getting on the same page, also pricing in 3 more hikes after some recent hot economic data from jobs to retail sales to input prices. The switch to expectations also comes on the heels of hawkish comments by Fed officials Loretta Mester and James Bullard, both of them saying that a 50 basis point hike would have made sense in January. Second thing to know, people are still staying home and they're ordering in. That's if DoorDash's numbers are any indication. The company's sales rose in the latest quarter as consumers spent not just on restaurant deliveries, but on groceries and household items, even as things got pricier. DoorDash revenue up 40% to $1.8 billion, and it ended the year with a record 32 million monthly users, while its subscription service DashPass hit 15 million members. And DoorDash expects the momentum to continue, predicting its order volume to grow again this quarter by more than what analysts were expecting. The third thing to know, Andrew Left of Citron Research, he said he was giving up on short calls. Remember that? After he was targeted following the meme stop craze. But that didn't last long, and his latest target is online marketplace IXIC. Left claims it has become one of the largest platforms for counterfeit goods. Citron says IXIC's previous defense that fake items were only a small part of its revenue is no longer the case. And IXIC, for its part, says it has increased tools to stamp out fakes. Well, Wall Street doesn't think the Fed fight will be over anytime soon. Goldman Sachs says it is now expecting the Fed to raise interest rates another 3 times this year, each by 0.25%. These fears have rattled the markets, with the Dow on track for a 3rd consecutive week of losses. And as I mentioned, you guys, Bank of America also joining in this morning, saying the same thing. The PPI report yesterday was sort of the straw that broke the camel's back, as it were, when it comes to Goldman Sachs. Their note was based on PPI, that is input prices, wholesale prices being higher than estimated. And they said that's why they had to raise their ending Fed funds rate target. What's interesting about all of this, of course, is that the Fed has been saying this, right? So we kept asking the question, are the markets going to come to the Fed, or is the Fed going to come to the markets? And it seems as though we have our answer. The markets are going to come to where the Fed has been.
Yeah, saying no salvation from inflation in this note. And one of the takeaways, I mean, look, I love the rhyme scheme that some of these notes have at the end of the day. But adding that 25 basis point rate hike at the June FOMC meeting, that also brings their terminal rate to about 5.25% to 5.5%. You kind of couple that with what we had heard from even James Bullard saying that further hikes would lock in disinflation. But it seems that the more aggressive tenor seems to be the, at least Fed speak, prevailing thought over the course of this week.
Part of being a successful investor is tying a lot of different pieces together. And over the past 7 days, or since that last Fed meeting, you've had Fed officials, to your point, Julie, come out here saying we're likely to remain hawkish for a little bit longer. The next shoe to drop here is now you're seeing Wall Street finally start to come around to this notion, and you're seeing stocks react accordingly. Now that hot tech trade probably done for the time being. Tech stocks don't like any indication of higher interest rates. And if you do not tie these things together, essentially you are a lazy investor. And maybe you shouldn't, in fact, be successful, because you are now having, I think, the likelihood that resurgent inflation, just to use Michael Hartnett's term in his note this morning, resurgent inflation, another rate hike, lower potential returns for stocks, not just tech.
Or you can just buy and hold, and you don't have to worry about any of that stuff.
Well, if you have a Warren Buffett the time horizon of essentially buy and hold forever, sure, you don't have to worry about these things, but that's not realistic for a lot of people on our platform right now. They are trading these markets, and I think they missed a lot of signals.
You know, for the other side, if somebody is saying, you know what, I'm just going to buy and hold and just sit on it for whatever my time horizon is, that does put other areas of spending in focus for a household. And we just saw some data from the New York Fed come out yesterday where, of course, there is good debt and bad debt. And some of that debt for the New York Fed, at least that we had seen come out, saw credit card spending over the fourth quarter of 2022. And overall spending, in aggregate, this debt had reached levels that we hadn't seen since before the pandemic, and even eclipsed some of those levels. So even though your home debt is probably good debt, as it would be considered, there's still a lot of tapping into credit and that debt that is more impactful and perhaps burdensome in this immediate term to really just combat inflation to the best ability possible. But then on the other side of this, where do you start to pay that down, and how does that impact some of the subprime and near prime consumers in the near term, and impact them over a longer term as well as they try to rebuild?
Well, and this brings up a good opportunity to remind people why it matters when interest rates go higher, right? If the Fed is raising another 3/4 of a point, at its next few meetings, interest rates go higher. That obviously, in most cases, means it will cost you more when you're borrowing to buy a home, to buy a car. If you're saving money, you're probably going to earn more on that money, right? If you're putting your money in a CD, in a savings account, it doesn't necessarily mean a huge increase, but it means you're earning something on your savings, whereas 5 years ago, you weren't earning anything on your savings. So there's good and bad, obviously, when you look at these different changes.
Absolutely. We're also tracking DoorDash this morning. This is thing number 2. DoorDash reported a strong fourth quarter, increasing revenue 40% year over year. But how are they helping their consumers battle rising prices from inflation? That's the big question. Joining us now to discuss, we've got Stephen Fox, Fox Advisors founder and CEO. So how are they doing it from your perspective, Stephen?
Well, they're doing a very good job of executing, that's for sure. It's important to remember that DoorDash is a game of inches, not a game of miles, even though they do operate in the last mile. And I think one of the things that they are focused on in this economy is making the goods they're delivering more affordable for the consumer. So they're working down inch by inch on execution and fees that help them stay attractive. The other thing that keeps consumers coming back to DoorDash is the subscriber base. The subscribers get a lot of benefits that make delivery more affordable, especially for people that maybe don't have time for various scheduling reasons to go out and get the food or the groceries that they need. All those things are contributing to a pretty good execution quarter that we think probably continues for the next several quarters.
Stephen, I think this is really the second quarter where I think the street really was surprised by what DoorDash had to say. I look at total order growth year over year, 27%, adjusted operating profits more than doubled year over year in the most recent quarter. Is it just that the street is underestimating how entrenched delivery of food or things are now just continue playing our lives post-pandemic?
Well, it is more entrenched. I think you've seen a big scale up since the pandemic. I think their gross order value is up something like 7 or 8 times versus just 2019, but they're still growing. The growth is going to slow, but at the same time, they're attracting better subscribers, which is adding to order frequency. They are also, like I mentioned, making things more affordable and executing better. But I think the messaging that the street has hung on to is that they are still in investment mode. But even though they're investment mode, this is the key point, even though they're investment mode, they're talking about generating $500 to $800 million of EBITDA in 2023. And that's a pretty good number. That's about 9% of the revenues we think they'll generate on 20% type of growth. So I think that's a pretty good profit number while you're investing. And last point, they're also showing better returns on their new categories that they're going into. So they're making profit improvements on convenience, which is now on the margin positive in terms of profits and still growing very fast, up 60%. And groceries, the losses there are starting to go down, but it's up 100% year over year in terms of gross order value.
Stephen, what's interesting to me about them getting more and more into things like groceries, delivery of household items, is that also, it increases their potential market, but it also increases who they're competing against. And I'm thinking of Amazon in particular. And whether you're talking about a DoorDash or an Uber Eats that is getting more and more into this business, there's a juggernaut that is in that business. Not quite in the same way, but I just wonder how you're thinking about that part of the competitive landscape.
Yeah, sure. So Amazon is in the last mile, but DoorDash is in the last mile, last hour. I want my groceries delivered in maybe 90 minutes, 60 minutes. I want my food in 20 to 30 minutes. And doing that and executing on that is a hard job. Even if you talk to DoorDash management, they'll say delivering groceries is not easy. And they have a lot of areas where they need to improve efficiencies, quality, which in turn brings customers back more and more. So I think it's a bit of a different ball game. The other interesting point is that DoorDash was founded at sort of the advent of e-commerce. And so they're building a network that fits the e-commerce age better than anybody else outside of like an Uber on the planet. And so I think that also is giving them advantages as you think about like guys like Amazon. And last point on that question would be, they're only, and I say this only because they just grew from 10 million subscribers to 15 million subscribers in 1 year. But relative to their available market or relative to like a prime subscriber base, that's still early days.
Steve, while we have you, there's been a push, whether you're purchasing an Airbnb rental or whether you're purchasing some type of concert ticket, or, in this case, just trying to get some food delivered, a push for fee transparency. Now, one of the issues that you do highlight is the fact that there could be this mandated wage increase for food delivery workers, and in specific cities. That's something that all of the gig economy has had to consider at one point or another. Do you see that impacting DoorDash in the long run and some of its competitors, and to what extent can they still push through price increases or fees?
Yeah, so that's an interesting concept because one, it goes back to the efficiency question. One of the ways that these companies, including Uber and including Lyft, are going to battle higher costs is through improving efficiencies. These are networks that, as you put more people on the network, they become more efficient. You develop different types of learnings. You leverage AI and machine learning, et cetera. But on top of that, yes, you're going to see some of those costs pass through to the consumer. How that affects their demand ultimately is to be decided, but it's a very complex business that they're running. And you're referring to the near-term potential in New York City, which New York is probably less than 5% of their gross bookings in the last quarter. So that's one piece of the puzzle, but there's dozens others to consider. And also the fact that they are investing at a certain rate, which they can adjust on the fly based on what they're seeing in their markets.
Fox Advisors founder and CEO Stephen Fox. Have a great weekend. Talk to you soon.
Great. You too. Thank you.
Citron Research is making a bold claim against Etsy, alleging that the e-commerce site has become the largest organized clearinghouse for counterfeit goods sales. The firm's founder, well-known short seller Andrew Left, is accusing the platform of walking on eggshells with the FTC, DOJ, and SEC after claiming Etsy allows its sellers to buy AdWords and label them credible websites. Etsy responded to the claim, saying counterfeit goods are explicitly prohibited on the platform. We'll speak with the man behind the bold accusation. That is Citron Research founder Andrew Left in the next hour.
Well, strong growth and persistent inflation have investors contemplating a new course for the economy in the coming year. A no landing scenario. You can read all about the newly coined outcome in today's morning brief over at the Yahoo Finance homepage. But for a deeper dive into what this means, let's welcome in Yahoo Finance's Alexandra Semenova. Okay, so forget soft landing, forget hard landing. What is no landing?
Yeah, so Wall Street has this new buzzword. We've been hearing it all week. It's the no landing scenario. It's a spin-off of the dichotomy of a soft versus a hard landing, one in which we see just a slowdown or a full-on recession. And in a no landing scenario, basically, the economy continues to grow while inflation stays persistently high, even as the Fed raises rates. And what's showing that markets are pricing this in is higher short-term rates and 1 year break-even inflation expectations rising and approaching 3%, particularly after the really strong jobs report, the strong retail sales numbers. And I've been talking to some strategists about what they make of this. And one really interesting perspective I got was from Greg Dacco over at EY, friend of the show. He said that this is nonsensical and basically that a no landing scenario is a non-event. So we know that the economy operates in a cycle. We see a period of growth and eventually it reaches a peak, then it contracts, hits a low, and then, we're back into an expansionary phase. And what he says is that basically, a no landing is just a delayed landing. And in fact, the longer we see the economy grow, the more, the higher the chances are that the Fed will continue to raise rates aggressively. And that actually increases the risk of a hard landing eventually. Nick Timeros at the Wall Street Journal, he put it well. He said that a no landing is a delayed landing.
Right, exactly. I've said I'm not a fan of the phrase no landing, but how the markets come up with this whole no landing idea and that they are now pricing it in to some degree.
Yeah, so, the Fed's extreme data dependence has kind of shifted the narrative over to markets. And so when we see these individual reports, markets are suddenly recalibrating their expectations really abruptly, getting the 500,000 jobs in January, getting the 3% retail sales number. These are actually outlier reports with a lot of seasonal distortions in them. And markets are suddenly adjusting their expectations and trying to figure out what's going on. Torsten Slok over at Apollo Management says basically no landing this year brings back the volatility that we saw in 2022 where, markets don't know what the Fed will do. But the thing is, this is another situation of markets not taking the Fed for their word. We have officials over and over saying that we're going to go to 5%, above 5%. James Bullard even at some point said 7%. So as long as we see, this continued growth, we will see more aggressive rate hikes and eventually we will get a landing.
All right, sticking on the topic of no landing, let's bring in our next guest who says that we may be running out of runway. Jim Bianco, Bianco Research President. Jim, great to see you as always. We'd love to get your take on our discussion here on no landing. Is it a real thing?
No, it is a real thing. I mean, no landing is basically, as you said, it's a takeoff on the metaphor about an airplane. And it just means that the economy's not going to slow down. It's not going to go in recession. It's not going to have a soft landing. It's going to continue to grow. And the fear is if it continues to grow, the Fed has no reason to cut rates. And there's heightened concern that inflation will not hit their 2% target because the economy's growing. And they might even continue to start raising rates. And you've seen that just this week now, the market is starting for the first time this cycle to price in more than what the Fed is suggesting. It's always been pricing in less. It's always been talking about pauses and step downs and pivots, but now it's pricing in more. And that we've got an expectation that the Fed's going to go to 5.5 in June. And it may not stop there if the economy continues to move forward.
Jim, maybe I'm just getting caught up in the language here, but the idea that no landing, I just hate the analogy because eventually the plane has to land, whether it's now, whether it's later, the landing has to happen, right? And I guess I'm just wondering, if it's not landing, are we looking at another decade-long economic expansion? It doesn't feel that way, does it?
No, it doesn't feel that way. But I think what people are expecting is that inflation, everything comes back to inflation. It's all about inflation. What they want or what they are hoping for, both at the Fed and on the street, is that the inflation rate's going to hit 2%. Well, the only way that it's going to do that, at least the belief is, the economy has to slow. And if it doesn't slow, then the inflation rate stays up. And if the inflation rate stays up, the Fed keeps hiking. And eventually, they hike to some number, as you mentioned, Bullard, 7%, or whatever number it takes to actually break the economy. There's an old adage, the Fed keeps hiking until something breaks. I could summarize what I just said. We've raised rates to 5%, nothing's broke. So let's go to 6 and see if we break something. Let's go to 7 and see if we break something. Wherever we have to break something. So yes, eventually the economy will land, but until it does, the heat's going to be on when it comes to interest rates. They're going to continue to stay up and maybe go higher.
Jim, on the topic of 2% inflation, I'm curious to hear your thoughts. So Fed Chair Powell said that he and his colleagues aren't going to budge on that long-term inflation target. But then some investors are saying that we're going to have to settle for 3 to 4%, that there are factors that interest rates can't quite fix, like, supply chains moving closer to home, making things higher, these post-COVID factors that will make us have to accept 3 to 4% inflation. Do you think the Fed will get back down to the 2% inflation target eventually?
Well, two things there. One, investors live in a fantasy land that they think that the Fed is going to redefine inflation at 3 to 4%. And I say that because Jay Powell could not have been more clear throughout the fall when he's been asked this question. They are not moving that target. Conversation over. You can stammer and you feed all you want that they should change it to 3 or 4% because you want the Fed to stop raising rates so they can start cutting rates so the stock market can go up. They're not going to do that. They're only going to stop when we get to 2%. Now, can they get to 2%? This is a very sticky problem. You mentioned supply chains. They're looking at, labor hoarding and tight labor markets with large wage increases. I've argued this is a post-COVID economy. Now, that's a fancy term. What does that mean? It's different. Everybody keeps talking about this is so uncertain. We don't know what's going on. The labor market's confounding everybody. Yes, because all the rules up to 2019 don't work anymore. We shut down the global economy. We reopened it. We need a new set of rules. We got to stop waiting for 2019 to return. And those new set of rules, what I fear, is going to lead to persistently high inflation. And we have to come to the reality that we are in a higher inflation and a higher interest rate world. But we don't want to do that. We want to say, change the target to 4%, cut rates, let the stock market go back to 5,000. Everything will be okay then. If we did that, 50% of the public has less than $1,000 of savings. They have no assets. They get killed if we accept higher inflation. We can't do that because it would be too painful for them. If it means tough markets, it means tough markets. And I'm just repeating what Jay Powell has said. You're very smart, you're very capable, you have assets, deal with tough markets. I'm not going to send the people that shop at Dollar Tree to be consigned to 4% inflation because you had a tough year in the S&P. I mean, I'm trying to be as blunt as I can. That argument just is not washing, I think, at the Fed. And I frankly don't buy it either.
Jim, I like your bluntness. It fits with my vibe for me that I'm feeling here on Friday. For those investors on our platform that are buying into this notion of no landing, at the most basic level, what stocks will suck wind in that environment?
The fancy term is long duration assets. Those are assets that are most sensitive to interest rates. Now, that's technology, that's growth stocks. Why? Because they're supposed to earn a lot of money off in the future, not a lot of money now. And if you discount what is Zoom's profitability going to be in 10 years back in a higher interest rate, it's a lot less. So those companies get hurt. What it helps or what companies do better are companies that are making money today, this afternoon. Energy companies, industrial companies, consumer non-cyclical companies that make money right now because you don't have to discount that money back. We're not worried about how much they're going to make in 5 years. And so those companies will do relatively better. Last thing I'd say about people on this platform, I've argued that in this new post-COVID world, we're going to go back to something like the 90s. It's going to be more like stock picking again. It's not going to be buy energy or sell technology. It's going to be which energy companies you're going to buy, which technology companies you're going to sell. We're so ETF driven. We just want to buy the sectors. We want the S&P to go up or the S&P to go down, that we forgot about that it's 500 stocks and some of them can go up and some of them can go down. And it's been so long, like a couple of decades, that we're going to have to start to relearn the whole art of stock picking all over again.
I mean, just to pick up on what you were saying about, even if it's individual stocks within these groups, about energy and consumer staples, for example, those groups haven't done so hot this year, right? Because the paradigm, the view, the sentiment has not been what you're talking about. What's going to change it? What's going to convince people that no landing isn't real and that, things are not going to go as the market is pricing in right now?
Those companies haven't done so hot this year because up until literally a week or so ago, the idea was the Fed's going to stop, then they're going to pivot, rates are going to go down. So all of the, the FANG stocks plus Microsoft, Nvidia, and Tesla, they've actually accounted for over half the gain in the S&P, just 8 stocks. And the other 492 have accounted for less than those 8 stocks. So that has been what has been driving the market. But if we're going to pivot now, use that Fed term, that we're going to see the Fed go beyond 5% to 5.5%. We're going to be worried that inflation is going to be sticky. Then those FANG stocks, those growth stocks are going to suffer. And then all of those cyclical stocks and those companies that are making money today, not what are they going to make in 5 years, they should rotate back into being in favor.
Jim, you always crush it for us. Be sure to follow Jim on Twitter, Bianco Research. Always a good follow. Jim Bianco, Bianco Research President. Thank you so much. And thank you to our very own Alexander Simonova. Appreciate it.
Thank you.
Coming up, we have a lot of hot tickers on the Yahoo Finance platform this morning, 2 of them being Moderna and DraftKings. We'll hit both after the break. Also, we are moments away from our big interview of the morning with Citron's Andrew Left, who just came out swinging against Etsy. You do not want to miss that chat. We'll be right back. Take a look now at some hot tickers this morning, starting with Moderna. The biotech company is out with interim results for its flu vaccine trial. Bit of a mixed bag here, as it met study goals for influenza A subtypes, however, fell short on meeting goals for influenza B strain. Shares under pressure off the highs. Moderna had been doing pretty well, Julie, but all not a good development for this company.
I mean, the whole investment thesis for Moderna is that the mRNA vaccines is a platform that you can apply to a number of other diseases, right? And so influenza was going to be the other one that they were going to tackle. And the problem with flu, like with so many viruses, is there are a lot of strains of the thing, right? This is why, it's sort of a crapshoot year to year. The various vaccine makers do their best to guess which strain is going to be most dominant. Sometimes they get it right, more so than other years, right? So that's why this is sort of a mixed result, because on the one hand, it did work against one strain, and on the other hand, it didn't work as well against the other strain. Now, what's going to happen now? There are some analysts, like our buddy Michael Yee over at Jefferies, who says he's optimistic that future studies are going to be more effective for this influenza vaccine, but investors not necessarily feeling that the case.
Yeah, and they continue to sell the mRNA advancements, mRNA advancements in the platform that you were describing as one where you could essentially just copy, paste, and edit for future, or to apply that same type of technology for future viruses or diseases. And so within this, it's also important to note that this is just one of the 5 influenza vaccine candidates that's being evaluated by the company. So, of course, kind of trying to diversify in that copy, paste, edit the number of different solutions that they've been able to come up with and then move forward with as well into trial there. But we'll have to see where the rest of those 5 candidates also, or the other 4 candidates, are able to receive some positive data in their trials.
Yes, we will see. In the meantime, the share's down more than 5%. Let's talk about DraftKings, another mover we're watching. Out with a beat on revenue for its latest quarter, the online sports betting platform lifting its guidance for fiscal year 2023. And the shares are up by 12% here this morning on the back of this. Remember, this quarter doesn't include the Super Bowl. The Super Bowl just happened, right? And obviously, we're only going to get expansion to more states that are going to allow sports betting in particular. But when you look at this forecast, it's pretty impressive. And importantly, the company is losing less money. It's still losing money, just not as much.
Well, they scored 2 big wins here, I would say, DraftKings. Well, first they raised. A little slow there, guys.
I thought it was 2 bets that you made.
All right,
2 big wins.
Ooh, that's good. First up, they narrowed their loss estimate for EBITDA, or operating profits, as I like to think of it. So that is an improved outlook. They're seeing this year $400 million in operating losses. That guidance before was about $525 million. Also, calling out about $1.31 billion in cash, and the team over at Cowen saying this amount of cash kind of, for now, removes any concerns about liquidity risk and the need for DraftKings to go back out to market and raise more money to support its ambitions.
Yeah, you look at the player data that came through as well, monthly unique payers there, that was at about 2.6 million versus the 2.5 million that were expected. And then the average revenue per monthly unique payer that they have, $109. The street was expecting $103.71. So as long as you have people, bettors, gamblers, continuing to come into the platform, perhaps wager a little bit more, refill their accounts, that's good news for DraftKings.
Good news for DraftKings. All right, we're coming up on the opening bell. Do you guys use DraftKings, by the way? Do you guys do this stuff? Am I allowed to ask you? No. Oh, we're not. And is New York even, is it even allowed in New York? Are we allowed to say this? No. I actually don't even know.
Yeah, we are.
Yeah.
It is legal in New York.
Is it?
Yeah.
Okay, if you say so.
Yeah, we're good to go.
I don't know what's.
I'll play Lotto sometimes.
I don't know what's.
I've done FanDuel. Yeah.
Lotto? I mean, I'll bet on that.
Lotto?
Yeah, I'll do Lotto.
Well, I mean, I don't. That's a whole other.
Whole other thing.
Got to pull the scratch offs.
All right, we got Wells Fargo ringing the opening bell here this morning on this Friday, as we have this pall being cast over the market by this perception now that we're going to get maybe another 3 interest rate hikes this year. All 3 major averages are down to end the week. It's been a down week already.
What does it mean for your money? I loved how we broke that down earlier in the show, Julie. Probably means maybe you don't go buy the extra pair of pants this spring season, because your credit card bill is probably going higher. But again, that's a little bit forward thinking.
Yeah, maybe that's. I think of it more as maybe you're not going to buy the house that you
or the car. I mean, some of these payments are they're going through the roof.
Yes, they are.
I thought we were going halfsies on a house.
Yeah, that's right. Yeah, I have my eye on a property in Pacific Palisades for you, Brian Sazzi. We were looking at it earlier.
No, that Austin Russell. Sorry, Brad. Austin Russell. Julie flagged me to this mansion that Austin Russell, Luminar's CEO, has been on our program many times. $83 million mansion. What, he bought it in 2021?
TMZ reported on it.
Wow, just $83 million. I mean, the house is beautiful, but Brad, we can't.
It better be $83 million.
We better write more stories if we ever want to afford that.
We can split $83 million. It's not going to be an even split, but
yeah, okay. Yeah, right. 80% on you.
As long as you're good with 99 to 1%.
Yeah, right. Okay.
Well, let's take a look at the major averages here out of the gate this morning. Dow Jones Industrial Average right now, it is sucking some wind, lower by about 0.5% at this point in time, and over the past 4 days, it's down this week by about 2%. We'll keep a close eye on that one, as we will the Nasdaq Composite. That's lower out of the gate by about 0.7% right now, and 1% in declines over the past 4 days over the course of this week. And the S&P 500, it's not any better there. Down this week and also down here this morning by about 0.5%, 0.6%. We'll round that off too. Let's take a look at some of the sector activity out of the gate as well, as we're tracking the 11 S&P 500 sectors. And here on the day, well, that's a year-to-date view. Let's put that on intraday. There we do it. And intraday, we've got XLU, utilities. That is doing well. It's flat, barely to the upside. It's in the green, though. Hey, we'll take some wins where we can get them.
Hey, Brad Smith, can you do me a favor for me? I'm sorry to interrupt your flow, but I was thinking about these sectors while we were talking to Jim Bianco a few moments ago, right? Can you do me a favor and hit up a year-to-date for the sectors in the S&P 500? Because his argument was that a lot of the tech high flyers, as perceptions change about the Fed, are going to come down, and groups like energy and consumer staples are going to go up. Now, on the year, energy is right in the middle there. It's down 1.7%. Consumer staples down 2.4%. Now do the past 5 days as we have seen these perceptions start to change, right?
With the no landing scenario.
Yeah, and energy is still the worst performer, but maybe that's going to change, to Jim's point. I don't know. Consumer staples have crept back up. They're up, well, they're still down 0.3%. But anyway, I'm just curious when this flip is going to happen that he was talking about.
Yeah, and it'd be interesting to track technology within all of that too, because if there is more of a reemergence of a stock pickers market, you have to wonder where the last bull rally has changed the thesis for a lot of investors out there in where they might have more propensity to do that picking versus some of the kind of moat or old school Warren Buffett portfolio plays back in the day.
Yeah, we'll see. I don't know. It's interesting. It's good food for thought. Let's talk about one stock in technology, incidentally, that's doing well this morning. As Applied Materials, beating estimates on the top and bottom line, while also providing a better than expected forecast for second quarter sales. But its display and adjacent market segment did see a year-over-year decline in net sales. The shares are actually not doing that much. Why do we care about Applied Materials? First of all, let's take a step back. It's the biggest chip equipment maker, right? So when we talk about all these semiconductor makers, how do they make the semiconductors? They buy equipment from AMAT, right? And then they make it with that. And some other companies like KLA-Tencor, for example. So this is another barometer on semiconductor demand, right? And these guys are still selling their equipment, although we did mention that one weak spot within the unit for the company.
Yeah, there were two major things that I took away from the call on Applied Materials here. They did, to your point on the demand front, they said that they're making good progress on closing their supply versus demand gap, but they did see recently one of their major suppliers encounter disruption impacting their second quarter shipments there, so keep a close eye on that. Also, the near-term perspective on the market, they provided a little bit of some of those headwinds that still continue to persist. Their customers facing demand dynamics, consumer-driven markets, PCs, smartphones, clearly weaker, the company is saying, while inflection-driven markets remain a little bit more resilient right there. And of course, if you were wondering, there was plenty of AI mentions, or at least one here that I printed.
Because what would an earnings call be without AI mentions right now, especially in tech? I'll just add this. This is a good week for old, boring tech. Cisco's exciting, but they had a very good quarter yesterday. I like what CFO Scott Herron told us about forward demand for his business. Good quarter out of here by Applied Materials, Citio noting strength in their power solutions business, analog, sensors. So nothing sexy on the surface, just good old-fashioned execution.
Yeah, it's only going to be a matter of time before J.M. Smucker starts talking about AI in their earnings reports as well here. Guys, coming up, Tesla is getting slammed with a new recall impacting over 300,000 vehicles. Recall, whatever you call it. We're going to break down the details next. Tesla is recalling over 360,000 cars with driver assistance software in the United States. It'll be entirely conducted via an over-the-air software update, and it comes after the investigation from a federal agency warned over the full self-driving feature on certain models, saying that it could have insufficient adherence to local traffic laws. So let's put it into context. We've got Yahoo Finance's Pras Subramanian. Pras, break this down a little bit for us. The details here about the Tesla recall and how they're going to issue this update, as well as what this means for production of future vehicles.
Hey, Brad. So, these issues have been known for some time now with Tesla's FSD beta software. But just to quickly sort of go through, what NHTSA had a problem with was basically, like you mentioned, certain local laws not being adhered to. So essentially, the car sometimes will drive through an intersection in a turn-only lane, not in a straight turn lane, a straight lane. Will blow through sometimes stop signs, controlled intersections. It may also not respond to posted speed limits. That software is supposed to adjust itself when it sees a speed limit. It may not do that. And then if the driver adjusts the speed limit above the posted limit, it will not autocorrect that either. So NHTSA says this could all lead to a crash. So they basically forced Tesla's hand into fixing these issues with a software update. We don't know how this software update will actually affect the features of FSD beta. We'll see how that happens. But this is a big issue for the company. We're talking about how software is a big component of the Tesla profit model, a high margin sort of offering. We had a Barclays note this past week talking about how bullish they are on Tesla's autonomous and their sort of technology. So not a good look here at the recall. And let's not forget that NHTSA and the DOJ are both still investigating Tesla over FSD.
Is this a detractor for any type of buyer interest in Tesla?
I think it might detract people from paying the $15,000 for the feature for FSD. You might say, you know what, I'll just buy the car. Once they iron out some of the software details, I can always add that feature later. But I mean, $15,000 for software to me is kind of, it's sort of an astounding number. But, like I said, 362,000 people actually bought this piece of software for, around 4 million cars that the Tesla's made overall. So around 10% of cars have this. So people have been buying it.
Hey, Praz, this has been a bad week for recalls. You have the Tesla recall, you had Ford with battery problems. What's the bigger takeaway for investors? Is it that this push to autonomous and electric power vehicles might be more tougher on these companies than is priced into the stock?
Speaking of electric vehicles, there might be some growing pains here, right, Saz? Especially with the F-150 just came out last year. This is bound to happen in terms of some technical snafus. Not sure how bad the Ford Lightning battery issue is going to be. They claim that they figured it out. We'll see what happens in a week or two. But yeah, I think you're right. There's a growing pains issue with a lot of these traditional automakers getting into electrics. But, want to note that, we saw this week Ram with a big recall on its diesel trucks, right? And then also Nissan with another recall week on its non-electric cars. So it's just part of the business, unfortunately. And with NHTSA involved, they're going to force these automakers to sort of do what's right for consumer safety. Good point. Praz Subramanian, thanks so much. Appreciate it. All right, for our chart of the day, we have pizza tickers, Domino's, Papa John's, and Yum Brands on the top of our mind. The price of a cheese pizza slice pizzeria has increased an average of 6.4% last year, according to 2021, per new data. The largest pizza price hike came in Idaho, clocking in at an increase of 22.8%. What kind of pizza is in Idaho, guys? What are they serving up there? Think gold dust? That's quite the price increase out of Idaho. Very interesting data from our folks over there.
Wouldn't that be right?
I'm just sourcing with Slice Intelligence, their data.
Man must be high.
I don't mean to question the intelligence of Slice Intelligence.
They're expert on pizza.
$28 slice of pizza?
Well, no, the price went up 22.8%. So that's
what though?
It's just, that's not what we didn't have in the graphic today, Julie. I'm just showing the price increase.
We need to obviously do some field reporting.
Because it's harder to get the ingredients that they need or something? And they're just baking that in?
Guys, I don't have all the answers. This is the data I got. This is our chart of the day. It's Fridays. We're going into the weekend. Coming up, our next guest is touting Dick's Sporting Goods' consistent positive free cash flow, but still holding out for a more attractive entry point in the stock. We'll speak with Blue Capital's Anthony Chicumba, always having some interesting things to say on all things retail. We'll be right back.
Toppings wrong.
Loop Capital is feeling cautious optimism towards Dick's Sporting Goods, initiating the retailer with a hold rating and a $130 price target, and touting its consistent positive free cash flow, but still awaits a more attractive entry point. The man behind that call, friend of the show, Anthony Chicumbo, Loop Capital Markets Managing Director. Anthony, it's great to see you. I got to tell you, Brian Sazzi and I have been talking about Dick's Sporting Goods because we each have had experiences as of late where we go into a Dick's, great space, lots of cool merchandise, and like crickets in terms of trying to get help on the floor of the store. So I'm going to start there instead of specifically on your call in terms of what you think about the staffing and customer service at Dick's right now.
I'm a little surprised by that because one of the things we really like about Dick's is that they do have superior customer service. I mean, part of that is the elevated footwear, departments. Part of that is the fact they own Golf Galaxy, the largest golf retailer in the U.S. And so, so they definitely have some pretty good customer service in that department, as well as, with Golf Galaxy, a lot of the stores have golf simulators and putting greens. So I'm a little surprised. That might be a little bit of one-off experiences, or maybe they just don't like you and Brian. I don't know.
Could be.
End of sentence.
I don't know. I was with my kid. We were trying to get some help on in the baseball section, but maybe.
Anthony, well, it's clear.
I don't know, but Anthony, they might not like Saz.
Anthony, it's clear all Dick's has to do is put a Bed Bath & Beyond in the store, and all their problems will be solved. No, look, we'll get to that in a second. But my real question here is, what is the inventory situation at Dick's Sporting Goods? How much inventory are they sitting on? Is it a big risk to profits and cash flow over the next couple quarters?
They don't really seem to have any inventory issues, at least that I'm aware of at this time. I mean, they weren't one of the retailers who had way too much inventory early last year and had to kind of work through it. So I think their inventory position is perfectly fine. I mean, if anything, look, one advantage that Dick's has a lot of relative to a lot of other sporting goods retailers is that they have this very, very close relationship with Nike, and they're getting a lot of, sort of exclusive, Nike product that you can really only get from Nike.com. So I don't think that inventory is a real issue for Dick's right now.
You know what? You mentioned Golf Galaxy. I'm going to bite on that because Tiger Woods is back. He's playing this weekend, and everybody's excited. So I need to ask for Golf Galaxy within Dick's, what type of growth do you need to see within that brand specifically? And does it have its own standalone power if Dick's would decide to say, spin it off one day?
Well, remember, that would be counter to the fact that they bought Golf Galaxy, right? I mean, look, Golf Galaxy's been great for Dick's, less as a standalone concept and more bringing that product into Dick's stores and making Dick's sort of the go-to store for golf equipment. So yeah, I mean, Dick's has about 730 of their core Dick's stores. They've got 130 or so different specialty stores, and Golf Galaxy is one of them. But I think to a large extent, one of the things that they've been really good at doing is testing different initiatives in these specialty stores, and the ones that work, integrating those into the core Dick's store. And I think it's really kind of an 80-20 rule where they're getting the vast majority of their sales and the profits from the core Dick's stores.
Hey, Anthony, what do you think is going to unlock the next phase then? If you think that your scenario is priced in here, I guess one of two things have to happen. Either the stock's going to have to go down for some reason, and then it would become more attractive, or something else is going to come to, help it higher, help drive a little more growth. Which do you think is going to happen?
So quite frankly, I mean, look, part of the reason that I'm at a hold rating is that I have a hard time seeing what that next catalyst would be, right? And if I don't really have visibility in terms of that next catalyst, then yeah, I sort of have to wait for the former, right? I have to wait for that pullback in the stock price. I mean, look, the stock's not terribly expensive relative to a lot of other stocks that I cover, but it is trading at about 11 times my 2023 EPS estimate, and the average over the last few years has been more like 9.5 times. The other thing, and look, it's a little bit unfair to Dick's, but it is what it is. I can't help but compare them to Academy Sports. Academy Sports trades at a 3-turn multiple discount to Dick's, and I think Academy Sports just has better square footage growth prospects. I mean, one of the concerns I have with Dick's is that core Dick's concept is pretty much saturated in the U.S. They've got about, like I said, 700 or so stores. Academy's got less than 300.
Anthony, one company that has no earnings, of course, is Bed Bath & Beyond. We have a rolling blog with this on you. How in the world did they get close to $1 billion in money, and does that keep them in business?
Yeah, those are great questions, Brian. So first off, let's not get it twisted. They didn't get $1 billion, right? They got 200 or so. They have an option to get another 700, 800. They have to jump through a bunch of different hoops to do that. Look, when I first saw this news, I was really scratching my head, particularly given the fact that I know the, sort of lead investor pretty well, and they're very, very smart money. But then once I started to peel the onion, I'm like, oh, okay, yeah, this makes sense. I mean, essentially, without going into all the specifics, because I don't want to bore your audience, the way that this works is that they issued this preferred stock, but the preferred stock is convertible to common stock pretty much at any time at a discount to the stock price, regardless of where the stock price is. So in other words, if the stock's at $2, then it's a discount to that. If the stock's at $1, it's a discount to that, all the way down to like about 70 cents. And as far as I can tell, there's really no restrictions in terms of selling the stock. So in other words, at any time you can convert your preferred into common stock, you get that common stock at a discount to the current stock price, and then you can sell that stock at any time. It's like a license to print money. I mean, it's literally heads I win, tails you lose.
So, go ahead.
Yeah.
I'll just say, Anthony, well, how does that, is that good for Bed Bath longer term? I mean, do they make it to next year?
So, look, desperate times call for desperate measures, right? I mean, they were on the verge of going bankrupt, and now they got this $200 or so million, and maybe there's more behind it. But given how fast they're burning through cash, I think this just, all it did was forestall the inevitable.
Anthony, just want to come back to something you mentioned here, because it actually got the wheels turning a little bit on Golf Galaxy, and really just giving away my golf fandom at this point. But when you think about the fact that they do have all of these add-on locations, and as you were mentioning, it sounds like much of the sales in that category are still going through Dick's proper right now. Does that mean that they would actually benefit then from perhaps closing down some of those Golf Galaxy capacities and then bringing that inventory more into where customers are already going for some of the other categories as well?
That's certainly a possibility. I mean, my guess is that in a lot of cases, the Golf Galaxy, the standalone stores, are in areas where they don't have a Dick's, and maybe it's just too small of a market to support a Dick's. But certainly that is something that they could do, if it made sense for them.
Luke Capital Markets Managing Director Anthony Chicumba, always good to see you, my friend. We'll talk to you soon.
Sounds good.
Coming up, lawsuits are piling up against Norfolk Southern following the train derailment in Ohio. We've got the latest next.
Shares of Norfolk Southern taking a hit in the month after a train operated by the company derailed in East Palestine, Ohio. That large chemical spill and fires drawing responses from government agencies, including the Secretary of Transportation, Pete Buttigieg.
Well, EPA has already sent a letter notifying, in a formal way, notifying Norfolk Southern of its responsibilities. Obviously, I can't get ahead of an investigation that is active and ongoing, but Norfolk Southern will have to answer to EPA for the environmental side and to our department if there were any violations of rules that were found that emerged in the NTSB process.
Of course, that was from our conversation with Buttigieg earlier in the week, and he's one of many politicians and regulators examining the company right now. You guys, the shares down about 8%, almost 9%, I believe, since this derailment first happened on February 3rd, and there doesn't seem a resolution. I've seen a lot of different estimates as to how much this could ultimately cost the company. We're talking tens of millions easily.
Yeah, and for what goes on from here, from the investigation, I think there are so many locals that are really just looking for answers, and it raises a larger question of what type of change will be sparked or prompted after this, knowing that there have been calls for better air quality coming through communities, better ability to have, even for some of the kind of highways, the different train routes that go through certain parts of cities, what exactly is traveling on those train routes as well? And that was something that he acknowledged in our interview too.
Yeah, this has all the makings really of something that lives on in Norfolk Southern's annual report, or 10K, for the next 10 years. Not unlike something we saw from Monsanto a couple of years ago, and still in their annual reports, about lawsuits because of various chemicals they put out. But of course, this is a longer term issue, could be financial penalties. Does it mean broader things to the railroad industry? You could even go so far as to say, is Warren Buffett's Burlington Northern Railroad impacted in some way? Do they have to reinvent their tracks? It's wildly unclear, but that's how investors in this space should be thinking.
Yeah, and obviously people in that town also, in a more immediate fashion, want to know exactly what's safe and what's not. Coming up, why our next guest is calling the China spy balloon incident a, quote, increasingly unavoidable distraction for the Biden administration. That's next.
Welcome back to Yahoo Finance on this Friday. I'm Brian Sazi alongside Julie Hyman and Brad Smith. Markets are feeling weak in the knees as Goldman Sachs lifts its rate hike expectations. All three major indices right now in the red, off the worst of the session, but still all three in the red as we go into the weekend. But Julie, over to you. Some breaking news here on the econ front.
Yeah, leading economic indicators just coming out and falling by 0.3% in January. Now, LEI isn't always a number that we watch, but we've heard from folks, the likes of Liz Ann Saunders over at Schwab and others who have said LEI has a little bit more importance right now. We're watching it closely. What is it? It's basically sort of an average or compendium of a bunch of different other economic indicators. And we are seeing it now down 3.6%. The Conference Board, which reports it, telling us that over the 6-month period. So down 3.6% over the 6 months from July through this past January. And that's a steeper rate of decline than the previous 6-month period. Among the leading economic indicators, according to the Senior Director of Economics over at the Conference Board, we're seeing deteriorating new orders from manufacturers, consumers' expectations of business conditions, credit conditions, all of those in the negative column, and more than offsetting the labor market strength that we have been seeing.
Yeah, they're saying that while the LEI continues to signal recession in the near term, indicators related to the labor market, including employment and personal income, they remain robust so far. Also adding, nonetheless, the Conference Board still expects high inflation, rising interest rates, and contracting consumer spending to tip the U.S. economy into a recession in 2023.
They didn't get the no landing memo, did they?
You know what? I hope somebody passes it to them on a sticky note, perhaps.
Yeah, maybe that'll happen.
There we go. Also here, President Biden made remarks yesterday addressing the aerial objects that were found in the U.S. and suspected to have been part of China's spy balloon program. Here's what the president had to say. Take a listen.
Nothing right now suggests they were related to China's spy balloon program or that they were surveillance vehicles from any other country. The intelligence community's current assessment is that these three objects were most likely balloons tied to private companies, recreation or research institutions studying weather or conducting other scientific research. I expect to be speaking with President Xi, and I hope we are going to get to the bottom of this, but I make no apologies for taking down that balloon.
As Biden looks to get to the bottom of this debacle with Chinese President Xi, we have Tobin Marcus, who is the Evercore ISI Senior U.S. Policy and Politics Strategist, here to take a deeper dive on U.S. and China relations. How rattled, how much more tenuous are those relations as a result of what's taken place with the balloons and what has been called in some circles balloon gate to this far?
Absolutely. Good to be here. So in terms of how concerned Washington is, it depends where you look. I think there's more new hawkish noise as a result of the balloon coming out of Congress, but I think Congress is going to be less relevant here given how challenging it is for them to get anything done in the current political environment. And when you look at the administration, and I think this came through in President Biden's remarks yesterday, they are, I think, not looking at China very differently based on what we've seen with the balloon than they were beforehand, which was already a pretty skeptical, hawkish outlook. You know, their strategy, they often talk about it as responsibly managed competition. I talk about it as hawkishness with guardrails. There are two elements. One is to be really unafraid to confront China on economic grounds. We saw that, of course, in the restrictions on semiconductor exports that were put in place last fall, along with a number of other issues from tariffs on down. But alongside that, to try and maintain diplomatic guardrails on the relationship. And I think that they largely are looking at the entire balloon saga as a distraction from both elements of that strategy. It makes it harder to focus on the fights they want to have that they think really matter more than this surveillance program, and makes it harder to maintain the diplomatic guardrails that they want to on the relationship to prevent the confrontation from spiraling.
Well, Tobin, sort of on that distraction front, well, we're all talking about the balloon. Meanwhile, a Pentagon official went and visited Taiwan for the first time since 2019. So, I mean, that would seem to me to be a fairly significant move, right? And if we're looking at avoiding the spiraling confrontation, that's not exactly pulling back from that, right?
Well, right. It is not a dovish outlook. I think that they are an administration that has shown themselves quite clearly to have hawkish inclinations when it comes to China. I think there's been a debate within the administration, and generally, you know, to put it bluntly, the hawks have come out on top. So, you know, it's not as if we should expect them to do purely conciliatory things, and they have been unafraid to ruffle Chinese feathers. when it comes to diplomatic outreach that had a greater chance of provoking the Chinese for what the administration thought was not good reason, whether that was Speaker Pelosi's visit last year or some of the congressional proposals to, change the name of the Taipei Cultural and Representative Office to kind of put Taiwan in there officially or allow the display of the Taiwanese flag in diplomatic fora. The administration has gone out of their way to try and tamp down those provocations. And again, focus the fight on the things that they care most about. I think that they're trying to kind of, save their the kind of points of provocation for the stuff they think really matters, and not have fights about less important issues. But by no means should we think that they're going to be, generally dovish or avoid anything that the Chinese might take umbrage at.
And so, to what extent have some of those efforts been effective from the administration thus far? And what more still is on the table for them to ultimately continue to prioritize and keep on the docket?
Absolutely. So, I think that the steps they've taken in some cases have been pretty effective. And certainly the gravity of those steps has taken markets by surprise in many cases. Certainly, I mentioned the semiconductor export controls that they put in place last year. That, I think, went substantially farther than most investors expected, a significant blow to China's semiconductor industry, particularly at the leading edge. And the follow-up a few weeks ago with aligning with the Netherlands and Japan to put similar export controls in place so that ASML and other tool makers outside the U.S. are sort of folded into that set of restrictions, I think was a substantial step forward. So those, I think, are quite real. And similarly, I think there was a lot of expectation coming into the administration that they would end up rolling back some of the Section 301 tariffs on Chinese imports across the board, $350 billion plus in annual footprint subject to tariffs that President Trump put in place. And thus far, they have not rolled back any of that to any meaningful extent. So, we're talking about things with real costs to the Chinese, and some would say real costs to the U.S. economy, since the tariffs were, sort of floated as a potentially disinflationary tool. Not that would have, been a silver bullet to fight inflation by any means, but could have helped at the margin.
So, Tobin, you mentioned a little bit of the effect that it's had on specific companies like an ASML, for example. In terms of what investors should be doing and thinking about when it comes to U.S.-China policy right now, are there areas, for example, they should be avoiding entirely because of the risks here?
Yeah, it's, I think the risk is a little bit across the board. The areas that the administration has mentioned as targets for further scrutiny, whether that's additional export controls or this idea of outbound investment screening that they're planning to put in place, are largely leading edge high-tech industries. They've talked about biotech, advanced computing, quantum computing, artificial intelligence. But I think mostly what they're going after there, or the stuff that they're most concerned about is, kind of joint ventures, foreign direct investment, stuff that's not really within the ambit of individual retail investors, trying to go after those leading edge capabilities. So I think that'll be a target, and we will continue to see movement there. I think that some of the most immediate risk to stuff that is relevant to retail investors has been taken off with the agreements on audit access that I think resolved the threat of delisting for U.S. listed Chinese companies. That is pretty much fully resolved for the next 2 years. So I think that is good news, even as the risk of confrontation remains. And then another one that's gotten a lot of attention and that's relevant kind of across tech, given where it's competing, is TikTok. This is a specific one where Congress has made noise. There's now sort of growing bipartisanship around some of the calls to ban TikTok legislatively. I do not think that is going to go anywhere in Congress. I think the thing to watch there is the ongoing CFIUS review of the company. I think at this point there is so much concern about China in general and the security threats posed by TikTok in particular, that's hard for me to see CFIUS signing off on the package of restrictions that the company proposed, sort of allowing it to continue operating in the U.S. just with additional third-party scrutiny. So if that review gets resolved, I think it probably gets resolved more aggressively with the divestiture order. That being said, I don't really think the administration wants to own the consumer backlash from really, really going aggressive there. So my base case is that ends up getting kind of dragged out indefinitely because they don't really want their fingerprints on either outcome. But that is one where, if it were to get resolved, that would send a pretty significant shockwave through the rest of the tech industry. I think at a minimum, bullish for some of the immediate competitors in the social networking space.
Tobin Marcus, Evercore ISI Senior U.S. Policy and Politics Strategist. Good to see you as always. Have a good weekend.
Thanks.
Head of Salesforce's March 1st earnings release. We are tracking a bearish note from Citi's Tyler Radke. Says Radke, we are tactically cautious on Salesforce into 4Q results as our partner checks indicate further signs of slowing demand from 3Q levels, shelfware issues, and overall front office Salesforce fatigue, which we think could limit upside to growth metrics in Q4 and the initial fiscal year 2024 outlook. Coming up, short seller Andrew Left is making a bold claim against Etsy. We'll speak with him next.
Well, Citron Research, a firm known for publishing reports on companies that its founder Andrew Left believes are overvalued or engaged in fraud, it's now touting claims that Etsy has knowingly or negligently turned its company into a hub for counterfeit goods. In its latest report, Citron asserts that searching for popular brands like Nike or Disney on Etsy will return a handful of counterfeits resulting from ads sold to vendors buying those keywords like Nike or Disney. And Andrew Left joins us now to talk more about this. Andrew, it's good to see you. It's been a minute. And you know, Etsy, this one was a little surprising to me, I have to admit. Just because I haven't heard from you in a little bit, although I know you've been making some other short calls. Kind of where did this one come from for you? Was it a matter of that you were looking for this stuff on Etsy and you got curious about it?
You know, it surprised myself. I was looking around the internet and just looking at sites, and I was on Etsy. And what I saw, I couldn't believe. Not only did you see some counterfeit goods, they're going to fall through it if you have a marketplace, eBay, you might be found some at Amazon. It was the complete exploitation, selling keywords. So I even went today, I put on my Twitter, if you go to Etsy and put in the word Louis Vuitton, you'll see they sell the ad word Louis Vuitton to the counterfeiters themselves. And if you put in Rolex, we're not talking about one or two Rolexes, 20,000, Louis Vuitton, Gucci. Forget about, those are luxury brands. Forget about Disney with 1 million, Nike. And then you realize something, wow, this platform has one monster copyright trademark problem.
I mean, we should mention the company did respond in a statement and said counterfeit items, fraud, other illicit practices are explicitly prohibited on Etsy. The company says the integrity is critical to the business, and they've increased their tools, they say, to try to crack down on these practices. I mean, one would think, as you said, this is an issue for any online marketplace, right?
Ridiculous. That statement's stupid, to be honest. Because this morning, I went to see after yesterday, put the report out, have they cleaned anything up? So go this morning, you can still, Rolex, there's 20,000 fake Rolexes, and you can buy the name Rolex. You have people selling not just Louis Vuitton fake bags, the actual Louis Vuitton fabric that's fake, buying the keyword from them. So they're not just on the marketplace. It's the double dip that's bad. You understand? And then they can have people who are trusted sellers. So it's a triple dip, actually. They're selling the names of these brands to the counterfeiters, which makes it worse than just having a marketplace for counterfeit goods.
Andrew, hey, Brian here. Good to see you. It's been a while. Let's say Etsy does go back and they clean this up. What is the stock at? Because I imagine if they wipe these things off the site, that's a big earnings hit, no?
So, it's funny because this was mentioned a few years ago and you don't know. So first of all, let's look at the legal problem. If they say, if they start getting sued and they have to go back and look at everything that was sold under Louis Gucci or under Disney, Nike, or you can keep going on, Chrome Hearts, Off-White, name any brand, right? It's endless and they're just in legal hell. And as for it has to be relevant because they're not policing it. If I understand they have a whole transparency report and they say they're policing it, but they're not. This is not a controversial call. It's anyone can see it. You go on, a Louis Vuitton purse is not $200, okay? A brand new one at 40% off that day. It's Canal Street. So for them to say it's being policed, it's not one or two slipping through. It seems inherent to the business. And if they're turning that blind eye, you would think, wow, it's more than 5 to 7% of revenues. And you know what? Maybe that stay-at-home mom or dad who's using Etsy and makes those Disney T-shirts, it might sound like a cute story, but that's a copyright infringement on Disney. If you actually enforce trademarks, copyrights, and counterfeits, could be 10, could be 15%, who knows?
So where does the liability stop with Etsy and then begin with the sellers? Because I'm just doing a search right now on one of the most easily counterfeited shoes that's out there, and that's the Jordan 1. It's been known to be counterfeited. It's made its way onto StockX and other resale platforms in the past. So where does that liability stop and then begin elsewhere?
Okay, so if you look at right there, what's interesting about that is you see trusted seller, eBay seller, and then you see, look at all those brands they sell as you're scrolling down right now. Jordan 1s are actually more difficult sometimes to counterfeit. I don't know what they're selling. You see Star Seller right there. So the Nike Charms. I mean, where does it start? If they want to make a claim, they go against them and they say, let's see how enforced this has been. If a few slip through, I understand. If you go to eBay, it's very tough to find a fake Rolex. Can you find one? Yeah, I'm sure, but it slips through the cracks. I'm not saying something's slipping through the cracks. They just recently had a lawsuit from the Cashmere Association saying that people are selling cashmere and it's not real cashmere. Now, I wouldn't put it on Etsy to test every piece of cashmere that gets put on the marketplace. That's actually a heavy burden, okay? So they did settle that, though. With this, I don't know. It seems could be really bad. It's just bad because it's been going on for years. So do they choose to make an example out of them? Do they let it go and you don't see it in the future? If something's been going on wrong for a long time, there has to be a reason why. And if you're a public company, it's probably because it's very profitable.
Andrew, we of course have followed your career for quite some time here at Yahoo Finance. For those that don't understand your process and how you go upon it, what happens next? Does Etsy reach out to you? Have they reached out to you? Do you expect them to reach out to you?
It's not a reaching out to me thing. Yeah. It's funny. Etsy's problem's not with me. Mm-hmm. Etsy's problem's with the brands. As you saw from Nike, go put in any brand out there. It is amazing. Okay, that's a real problem. To them to say, hey, the short seller, can you imagine the guy on Canal Street who gets mad at the maybe a policeman who takes the counterfeit goods? That'd be quite foolish. What's amazing about this is if you tried to sell these goods on Canal Street or anywhere in any city, you'd get arrested and get thrown in jail. In Wall Street, you can institutionalize it and make $50 million for yourself selling stock. So it's a class thing. It's a counterfeit thing. Go look at right there. I'm seeing you're putting that up right there. Amazing. This is not like one-off. This is big.
Yeah, I guess I just wonder, like, I mean, if you're,
I was amazed. You have to look at this yourself.
But I guess what I'm saying, like if you're saying it's so profitable, like if you're a consumer and you're looking at this and I mean, if it's so obvious that they're counterfeits, are people really buying this stuff? Like, is it really such a big part of their business?
First of all, counterfeiting is a multi-billion dollar
Sure,
industry.
but like you look at this stuff, I mean, half these Rolexes say Ro.Lex. I mean, like, you're not buying a real Rolex.
No, you're not. They don't say Ro.Lex. Most of them, if you look at them, they do say Rolex. They're copies. You're looking at some right there. Go look. I'm looking at one right there. I've seen right there. The blue one right there. It's Rolex. These are fake Rolexes. And by the way, if you look at their terms and conditions, it says anything that's meant to replicate. So even a Ro.Lex would be something that's meant to deceive or replicate. Yes.
Yeah, I think if anybody comes on and they think they're buying a Rolex for $300,
that's the whole idea. Listen, the victim is not the consumer. The victim's the brand. Why are we allowed to rip off Disney? Why are you allowed to rip off Rolex?
Well, Disney usually is very aggressive about these things, so I'm surprised if there's really so much counterfeit that they're not coming in here.
Andrew, put in the word Disney. 1 million returns on Disney. You'll see a million hits. If somebody buys a fake Rolex, is that a victimless crime, or is Rolex is ever trademark in Disney and Nike? You can't copyright infringe on them because the person who's buying it knows it's fake.
Andrew, I want to take a pause from this for just 1 second because there's something else I want to ask you about. And that's like, I talked to you like a year ago and you were done with this, right? At least for that. You said, I'm not going to be a short seller anymore. The meme stock thing, to be fair, you were getting like death threats. Your family was being targeted. You were taking a lot of heat over your short calls on some very popular meme stocks. And you said, I'm going to step back from it. Obviously that didn't last. What happened?
There's a difference. Let's say GameStop. What GameStop was doing is they were running a bad business. Running a bad business is not illegal, okay? I said, if I'm going to go ahead and start short selling or be more active, I want to look at things that are actually obvious and illegal. That is what we see with Etsy, okay? This is not a battleground. We're not going to argue here if somebody copyrights a Louis Vuitton or a Rolex. It's illegal to sell counterfeit. You might call it victimless because the person who buys it, but don't forget, Etsy is one, selling the name. I put in this morning, I put on my Twitter, Louis Vuitton, they're selling it to a counterfeiter. Okay, that's one. Two, they're collecting 6.5% commission on it. Okay, they are working with the counterfeiters and they gave them a platform, a payment system. I can't go to Canal Street and use Apple Pay. Okay, so they're giving them a payment system and a platform to sell counterfeit goods. That's illegal. If I did that right now, I have no doubt that DOJ would be at my house in 3 hours. And so we're talking, forget about valuation. It's illegal is the first thing. And then we could talk about what kind of hit to the company should it be.
So, okay. So basically the answer I'm getting you from it is you couldn't stay away. Like you couldn't resist.
No, the answer is not that. It's not against the law to have an overvalued stock. I said, I'm not going to discuss overvalued stocks. We could sit here and discuss it all day long. We want to buy a GameStop because it's going to go to the moon. Go ahead, have fun, right? And if Etsy goes higher, it goes higher. What I'm saying is that Etsy is operating illegally. This is not a battleground issue. This is a black and white to anyone who has a computer.
All right. Citron Research founder Andrew Left, who is back in the publishing game, at least for right now. Andrew, we appreciate the conversation and the time this morning. Thanks so much.
Have a good day.
You too. Guys, coming up, user customization is coming to ChatGPT. We've got the details next. Microsoft-backed artificial intelligence service provider OpenAI is looking to address the issue of bias in its chatbots' responses. To do this, OpenAI is developing an upgrade that'll allow users to customize ChatGPT. For more on that and what it means for the emerging AI industry, let's get to Yahoo Finance's tech editor, Dan Howley. Dan, what does this all mean?
That's right, Brad. We're seeing kind of a pushback from certain political circles regarding ChatGPT and other AI platforms, such as Microsoft's Bing, which is powered by a version of OpenAI's ChatGPT. And presumably when Google's Bard comes out, they'll get hit with the same kind of thing as well. And essentially, there's some on the conservative side saying that the AI is woke and biased against those political points of view. And so now ChatGPT is responding and allowing users to customize their own bot, basically. You'll be able to allow certain content to go through or have access to certain content that even ChatGPT developers or OpenAI employees would otherwise not approve of on their own. And so this is kind of a new pushback that we're seeing against this. We're already starting to see some with regards to the different types of jobs that this could endanger. That's been an issue with AI for some time, but we're also seeing, how the AI gathers information. There's it's scraping the web. There's news organizations like CNN have come forward and said, we recognize that our articles are being used to help inform the AI. We don't want that. We don't, want our property to be used for this purpose, and we didn't sign off on that. And so we're seeing this broader pushback, I think, in AI. And as it becomes more mainstream, at least generative AI, I think we'll continue to see that. And, just as a broader statement, AI has been around us for decades now. So it's not as though conversations around AI are new. It's because this is a hot idea, generative AI. And so people are now kind of jumping on it as a new kind of bandwagon to either approve of or disapprove of.
Yeah, definitely. The hot new topic indeed. We've been talking nonstop about it. Dan, what can we make of Microsoft's response to criticisms of that ChatGPT-powered Bing version returning inaccurate search results? And this is something that you've kind of played with yourself.
Yeah, so I actually am using the new Edge browser with Bing built in, and I've been using Bing for just general research for articles and whatnot. And I did run into issues of my own. Now, Microsoft says they're working to kind of flesh out the different problems it may have with inaccurate statements or with kind of emotional responses. There's been some users who said that it can get aggressive. It's not like, threatening you, but it can be a little spicy with its replies. It's not cursing. It just feels like, oh, all right, you're taken aback by it. But, in my particular instance, I did something. I was asking for Apple's latest quarterly statement. It provided that data, and then it followed up by giving me what it said was the statement prior to its Q1 report. Turns out that was the Q4 report from 2022 or 2021. I asked it for the 2022 report. It said that hadn't come out yet and wouldn't come out until March 2023. Obviously, that's wrong. And so, I said that was wrong. It said that no, it's just not coming out until March. So
human, you're the one who's incorrect, not
wrong.
the computer.
Yeah, it's gaslighting me basically there, and that's something that other people who have been using it have seen. So Microsoft says this is obviously still in preview. This isn't available for the general public, and that when you're looking at these answers, you can't expect them to be definitive every single time. The problem is, at what point do you start thinking that they're definitive, right? So I've asked controversial questions about conspiracy theories. One of them was about 9/11 being an inside job. I bring this up because it's something that you should be able to definitively say no, but it said that that's a matter of debate and speculation, which, yikes, is not really the response that you want from a product like this. So, I've asked it about vaccines. It's very clear about vaccines, and the link between autism and vaccines not being real, things along those lines. So, there are positives and negatives where, it does give you the right answer in some instances. In others, it doesn't. And so that's something that Microsoft's going to have to continue to work through before they eventually kind of unleash this on the general public.
Yeah, sounds like an artificial intelligence language that could use a few more conversations in order to have a full story there. Thanks so much for breaking this down and really starting the conversation for us. Our own Yahoo Finance's own Dan Halley. Well, to many, artificial intelligence is a relatively new thing, but it's been around for decades here. So now the buzz around AI is larger than ever, thanks to tailwinds from ChatGPT, which has seen its usership explode since it opened for public testing in late November. But is the AI hype cycle nearing its peak, or is the round of AI developments just the start of even wider adoption? So to help us answer these questions, let's bring in and get to Identity.com CEO and Apple App Store's founding director, Philip Shoemaker. Philip, great to have you here with us today. Help us go further into this conversation of where to next in terms of the early phases of generative AI and where that adoption and even user cases are starting to emerge.
Yeah, thank you for having me. It's been a long time since we had an AI hype cycle like this, right? I think it was the 80s when people like Gary Hendricks and Marvin Minsky were pushing this, and there was all this investment in AI in the 80s, and it went absolutely nowhere. So I'm happy to finally see it resurrecting, and we're seeing a lot of use cases now in things that are a little simpler to solve, like machine vision, being able to recognize a person, being able to recognize faces, being able to recognize different types of products and people in general and objects. So machine vision is coming along really far. But the big thing I think we're seeing is that the internet has this boom of this data capture, right? Where all our data is being captured all the time. And that makes it amazing for AIs to be able to train. I mean, as you just heard from the ChatGPT stuff, it depends on what you train it on. If you're training it on only wokeism, all you're going to get out of it is wokeism, right? So you need to train it on everything out there so it generates its own opinions and you get some good data on it.
And one of the things you said in your notes that was interesting is that no AI company has ever turned a profit. I mean, of course, many of the companies doing AI now are already very profitable at other stuff. Right, so that seems to be changing the calculation a little bit. We had just put up on the screen a minute ago some of what you're dubbing the potential winners in this group, and some of those are examples, like an NVIDIA or AMD. Yeah. How are they going to capitalize on this? Why are they going to be winners?
Well, these guys, I think just like in the crypto space, the biggest winners have been those that are working on picks and shovels, like in the gold rush, right? Don't actually go and mine the gold. Create the genes, create the picks, create the shovels, and those are the companies that have long-lasting value. And in this case, companies like AMD and these chip makers, AMD, et cetera, of course, Microsoft and Google, Alphabet, but these chip manufacturers are the ones that are making it really easy to be able to handle and power these AI systems. So I think the picks and shovels makers in the AI space, much like in the crypto space, are the ones that you should hold on to because they're going to generate a big profit. Now, what I said about that pure AI companies, right? Historically, since the 80s, people have been investing a lot in AI, and it's given us little teeny improvements here and there. This has been a long time research effort for most of these AI companies that we're only starting to see fruition. So the ROI on these things is incredibly long. But these chip manufacturers, these ones that are leading the way there and starting to build their own tools and their own AIs to boot, are the ones that I think we're going to see great success with.
Philip, you mentioned before the AI companies looking to maybe build in something like wokeism or whatever it is. Are there any safeguards being put in place to prevent biases like that?
Yeah, I think that's one of the issues that we're seeing is that I think most are going to be putting in safeguards. But here's the problem with any sort of war, right? And the AI wars have just begun. And I don't mean AIs and Terminator type of thing. I'm talking about just these companies that are battling against each other to have the strongest AI out there. So what's going to happen is they're going to start adding features too quickly that have unintended consequences and could be dangerous, right? So imagine if the ChatGPT was trained on saying things like saying that like 9/11 is fake or that vaccines are bad. That could be really detrimental to the environment, to our survival as well. So I think that's one of the biggest things is that we don't know what safeguards there are. We don't have any laws or regulations in place that tell these companies what safeguards to put in. But boy, we need something along those lines because we find that if you don't regulate it, if you don't have a policy, these things can get out of hand.
Phil, it sounds like we're overgeneralizing the use of wokeism and kind of truncating a few topics together. So just to be super clear about this, there are things that have definitively happened in history that we know for a fact are bad or have other factual elements that are around them that we all know to be true, but the interpretation has been misguided or in some case perversely used. So how can we ensure that that is not something that makes it into generative AI?
Yeah, there's two types of training of these AI systems. And as I said, we have so much data out there that we can train a lot of good AIs. But there's two types of training. One is supervised and one is unsupervised. The unsupervised training is what you're seeing now. You're seeing ChatGPT and others just accessing a lot of data, grokking it, understanding it, getting it into their vernacular, getting them to understand it. That causes a problem because if they just go strictly based on the information that's out there, we know there's a lot of falsities out there, a lot of lies that people have spread on the internet. And so people need to supervise and say, this is true, this is false, and put it into the system. And that's difficult to do. Having a lot of data means that you have to have a lot of people sort through that data and make determinations on what's accurate and what's false. And sometimes us humans make those incorrect statements. I mean, if you look at history lessons, a lot of our children get these history lessons wrong. They don't know what happened in the past is factual. But look, if they start bringing in real history books and things along those lines and start understanding that, we'll be in a better place. So it's all about supervised training of the AI.
Identity.com Executive Director and Founding Director of the Apple App Store, Philip Shoemaker. Good to see you. We'll talk to you soon.
Thank you.
Coming up, Business Class Brad is back with a deeper dive into those Deere earnings. You won't want to miss that. We'll be right back.
Investors double down on Deere, the agricultural equipment maker, leaping ahead after riding on higher demand-driven sales. The company reporting strong earnings and noting its higher levels of production, but can that counter softening demand elsewhere? Business Class Brad has the answer for us.
Yes, well, taking a look for today's SWOT analysis, starting things off as we always do with the stock reaction to the most recent earnings from John Deere, moving higher, and it's the number 2 trending ticker on the Yahoo Finance platform right now. It's up by about 7%. And into today's SWOT analysis first with some of the strengths and weaknesses. Oh, hey, we got the cartoon today. Awesome. All right, taking a look at the strengths. First and foremost, got to call out the production here, because when you think about the rates of production and what Deere had spoken about within this quarter, that unit production rate that continues to improve, that helps them move through some of that inventory and actually churn the inventory, get it out the door to their customers. And all of their operating segments, they had higher shipment volumes. And you take the price consideration into that, that was also elevated. So elevated prices were able to move through some of that inventory, get it into their wholesale distributors and customers, purchasing customers. That helps them move through backlog. Revenue on the back of that also moved higher by about 32%, 33% there. And so continuing to think about what not just the strengths were, but some of the weaknesses and where they need to continue to improve. Well, it's in the cost of sales and what it's actually taking them off of their balance sheets in order to get some of that inventory into customers. So that cost of sales, that was actually up by about 18.5% year over year. And then additionally, that research and development spend. Now, sure, there are some flashy components to Deere that even prompt them to show up at CES with some of their newest machinery. But at the end of the day, that research and development moved higher by about 22% year over year. And these two categories outside of their selling, administrative, and general expenses are the largest expenses for John Deere right now. So that's the strengths and weaknesses approach for John Deere at this point in time.
I loving this SWOT analysis. Brad, thank you so much. Appreciate it.
Well, wait a minute. I got two more for you. But wait, there's more. As the late, great Billy Mays would say, we got to talk about the opportunities. The other half of this SWOT analysis, production and precision ag segment here. And so for the production and precision ag, you saw net sales move higher by about 55% year over year. But here's where it gets real juicy, or where there's a lot of things to be harvested out there. And it's in that operating profit for the first quarter of 2023, higher by 308% there. Higher shipment volumes, once again, contributing to that, and price realization. The company also continuing to monitor this segment because they're driving healthy demand. They've got order books that are still full into the third quarter of fiscal year 2023. And then lastly here, just got to talk about the threats to round this off on John Deere. They've seen some softness in Europe. They're expecting flatness to about up 5% for this year. However, in Asia, they're calling that sluggish, and they've talked about this in recent earnings calls as well. They're forecasting for that to be down moderately within that region. So that, the full SWOT analysis on John Deere here today.
Wait, you don't have any more? Any more? You got any more pictures behind there?
Can I actually say one more thing?
Julie, go. We'll let you.
I mean, I don't know if you can hop on over. We got to go.
Got to go.
Grain prices are still super high. They've come down a lot, but if you look at a 5-year chart of a lot of grain prices, they're still high. Farmers have a lot of cash, and you know, they want to spend it, at least some of it, on tractors.
Look at this dude. He's crushing it.
I'm trying to find your grain prices.
It's okay.
I'll show you.
Gotta move. Gotta go. Coming up, I sat down with entrepreneur Mark Laurie as he unveiled his new ghost kitchen in New York City. We'll be right back. A new food delivery concept has entered New York City. Mark Lorry, the guy who co-founded Jet.com, just launched the first physical location of his most recent startup wonder. It's a ghost kitchen that features dishes from the country's best chefs and delivers the food hot right to your door, but only within a 6-block radius. I sat down with Lorry and to go inside his new business and what he plans to do with it.
All right, joining me now is Mark Lorry, serial entrepreneur is what I'll call you, inside of Wonder in New York City. What is Wonder and why are you launching it?
Yeah, sure. We're really elevating the at-home dining experience through pickup and delivery. But unlike what's available out there today, ghost kitchens and things, this is very different. There are going to be 30 different restaurants, some of the best restaurants from around the country, every cuisine. We hooked up with some of the best chefs around the country to put all 30 restaurants cooked right back here in our kitchen. So it's a massive kitchen, 30 restaurants cooked. You can shop across all 30 restaurants in a single checkout. And the goal is, because we've got so much density, given how many restaurants we have coming out of this location, we're only going 6 blocks in either direction. So imagine a 6-minute delivery by electric bike. And we're averaging about just under 10-minute cook time per meal. So end-to-end order to eat. When you order off hours, you're going to get it in 15 to 20 minutes. During peak time, we'll leave a little bit of a queue for labor efficiency, and so it'll be around 30, 35 minutes. But again, you're going to get this incredible quality food, piping hot, delivered by our own Wonder couriers with the chef coat and the hat in a beautiful bag, really fast, on time. For across all the restaurants.
How do you get these chefs to part with their babies, these recipes? Do you make the food in here? Do they make the food?
No, we make the food in here. We go through a very strict, learning phase with them to make sure that we're able to replicate the food to their standards. But once we do that, we've systematized it where the food comes out consistent every time, which is one of the keys to the model. So it's not, the food doesn't vary as much as it would in a typical restaurant.
So I've followed your whole career. You've done diapers, you've done e-commerce and Jet.com, you've done Walmart. Why the big bet on food and food delivery?
I just think that the food market is ripe for massive disruption. It's been a really long time since you've had any real technological innovation in food. And you combine that with what's happening with food delivery. 2010, we're at 10 million in revenue. Fast forward 13 years later, we're $100 billion in the U.S. in delivery annually, and we project it's going to go to nearly 600 billion by 2035. So I think we're seeing that the younger generations are putting a premium on convenience. They want to spend less time cooking, more time enjoying time with their family.
I don't want to cook.
You don't want to cook anything. Nope. Yeah. So we think that that's like a really big mega trend. That's a tailwind here. And it feels kind of like the early days of e-commerce, where it started with marketplaces and then Amazon came with a robust first-party offering. That's the place that we want to play here in this market, which is come to this delivery market with a really robust end-to-end vertically integrated first-party experience.
Come to us with some food. Let's go. Oh, this is pretty good.
Menu.
That is
shrimp tacos from our bar.
Impressive.
Thank you very much.
Impressive stuff. Part of me, I'm going to be eating.
Yeah, what do you think? That looks pretty good.
I think it's a pastrami sandwich. It's pretty good.
Thank you. And these are
shrimp tacos.
Shrimp tacos.
Mark, how do you scale these things? Scale this up. Like, how do you go from 30 locations in the city to what is your ultimate vision for this across the country?
I mean, ultimately, like if the market plays out the way we think it will, this is 5,000-10,000 units across the U.S. Mm-hmm. But obviously, this year we've got 10 planned. So I think it's all a matter of proving the 10 that we do, that we can get these things profitable, have a really good return on CapEx. Mm-hmm. Customers love it, really high net promoter scores, great repeat rates. I do think it's much easier to scale this business because we're looking for 3,000, 3,500 square feet, essentially restaurants. We have no open flames, no hoods back there, no grease traps. It's all electric. So literally, we just find 3,500 square feet. We can build this out in a few months, and then we're up and running.
You just took over as what? CEO? What made you step in October? What made you step in there?
Yeah. I don't know. The only analogy I can
You're a busy
say, because
guy.
I use this as like I was coaching and just really missed playing. I just wanted to get back on the field. And it's once I did that and it started rolling, now I'm so hooked. It's
does it feel like the early days
it
of
feels
Jet.com?
I'm more, people find this funny, but I'm more fired up, more motivated, more driven, putting more time into Wonder now than I did any startups in my past. And it's because I feel it. I just feel it. I know this is it. I know that we have a massive opportunity to change people's lives and change how they eat and to really elevate this at-home dining experience that everybody wants.
So if I'm right, you've raised, what, $850 million?
Yeah.
How much?
$800 million of equity.
$800 million of equity. How much do you need to make this vision come to life?
I mean, it's done in stages. And so, we're going to raise a couple $100 million into the late summer, into the fall to bridge into a big growth round in early 25. And then from there, it'll depend on how fast you want to grow. But, it could be anywhere from as little as maybe a billion or so to many billions if we wanted to really ramp it up.
You think it's a public company?
Yeah, definitely.
Well, that does it for us. Coming up in the next hour, Rochelle Akuva is going to have you, and she'll do a deeper dive into those Deere earnings with an analyst from Stifel. Plus, we've got a forward-looking programming note. Saz is going to be in Florida next week for an exclusive interview with Double Line founder and CEO Jeffrey Gundlach. He is known by many as the new Bond King. That does it for us. Have a great weekend, everybody.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. The hawks are in charge. Risk assets come under pressure as Fed speak hinting at higher rates spooks the markets. We'll look at the impact on Bitcoin as the SEC crackdown takes shape. And what's the impact of high inflation and recession talk on business leaders in the grocery space? We'll speak with billionaire John Catsimatidis on exactly that this hour. And President Biden's nominee to lead the IRS faced the fire in the Senate this week. But where should the focus be for an agency that touches so much of the economy? We ask its former commissioner. But first, let's take a look at the major indices 90 minutes into the trading day. We see they're all three in negative territory. The Dow there down about 0.25%. The S&P there down about 35 points on the day. Nasdaq taking the biggest dive there, down 1.2%. We know Apple and Microsoft weighing on the Dow and the Nasdaq, while energy, the biggest sector laggard in the S&P today. Let's also check in on the Treasury market as well, see how that's faring among all this hawkish Fed speak. As you can see there, that's helping some of these short-term yields. You see there the 5-year up just 0.1% there, the 10-year also in similar territory, and the 30-year relatively flat as people consider what might be happening in terms of the potential for another interest rate hike added to this year. Well, the crypto crackdown continues with news that the SEC is suing Terraform Labs and co-founder Do Kwon. Now, this after a full week of headlines as scrutiny of the space intensifies. Here with the latest, Yahoo Finance's David Hollerith. Hey, David.
Hey, Rochelle. Clearly, in the U.S., crypto industry firms have been playing defense since 2023 started. Now, this latest action from Thursday afternoon from the SEC alleging that Terraform Labs founder and CEO, as well as the company itself, defrauded investors is definitely less controversial, we might say. Many will recall the collapse of the Terra blockchain ecosystem at the beginning of May of last year. And the breaking of Terra's algorithmic stablecoin, UST, from its $1 price is in many ways what initiated crypto's 2022 collapse. Although obviously there are plenty of other industry participants where fingers can be pointed. But this is the SEC's fifth enforcement action in 2023 against crypto firms. And it follows the $30 million charge against crypto exchange Paxos for its Kraken for its staking program, as well as notice that Paxos, the stablecoin issuer, said on Monday that it had received information from the SEC saying that the SEC could potentially put an enforcement action against its own program. And then also the SEC has proposed a new custody rule that would tighten requirements for investment advisors holding on to the crypto custody or the assets of their clients and how they custody them. So at a high level, this might seem obvious that this is in a lot of ways a U.S. regulatory reaction to last year's collapse in cryptocurrencies. But firms are plenty critical of this regulation by enforcement approach that has been going on. And there's been a number of accounts I've just had in conversations of crypto firms, startups especially, that are considering leaving the U.S. market as a result.
And we know that obviously the SEC chair, Gary Gensler, did have that warning there, that shot across the bow, that some of these companies should be aware. And so as we continue then this big push for regulating crypto, how are those markets reacting to the news?
Yeah, it's interesting. It's definitely been sort of a tale of two stories for cryptocurrencies. While there's been all these, there has been specific regulatory reactions, particularly based around Coinbase, which gets revenues that could be implicated by some of these enforcement actions. The crypto market is largely still being led by Bitcoin, which in turn has been dominated by this hot and cold macro environment that we've been in. And after Tuesday's inflation report, Bitcoin had a sizable run in. That came, at least in part from a number of short position liquidations that carried through Wednesday, and as well as an uptick in trading activity in Asian markets. Bitcoin rose $25,000 or above it Thursday, and then also Thursday evening we saw about a 3% correction. Interestingly, the largest cryptocurrency, which is generally more volatile, isn't showing quite the same change in volatility as seen in the bond and equity markets. In the options market for Bitcoin, funding rates and the futures basis for Bitcoin aren't really showing any warning signs yet either. And so the tension in the rates market right now hasn't really shown up quite as much as we might expect in cryptocurrencies.
That's interesting, considering how we used to see those wild swings matching, but a different story here. Interesting stuff there, Dave Hollerith. Thanks so much. Well, interest rates, of course, hitting more than crypto, with housing also feeling the bite. But while a slowdown there could indicate recession, markets may not reflect the reality yet. Here with more, Jeff Schultze, investment strategist at ClearBridge Investments. Good to have you on the show, Jeff. So I want to ask you, in terms of what we're seeing now, we know that there were this counter trend rally that we saw from markets, didn't really want to listen to what the Fed was saying, or perhaps just honing in on what they wanted to hear. But where are we now after this week of hotter than expected inflation data?
Well, I think we're clearly at the bias for upside for rate hikes as we look forward. If it was just one data point in isolation, the Fed could look through that, but there's been a myriad of data points that shows that not only the economy is not weakening, but it may be accelerating at this point. Obviously, starting with payrolls and non-manufacturing PMI, and moving over to retail sales and the CPI and PPI reports earlier this week. So obviously, you've seen Fed fund futures price in about 3 rate hikes over the next couple of FOMC meetings. And I think the bias is to the upside if this pulse of acceleration that we're seeing really is genuine.
And so a lot of people wondering what that means, perhaps seeing that extra rate hike. We know that that's what Goldman Sachs was saying, perhaps another 25 basis point rate hike. But we hear a lot about no landing, soft landing, but we're hearing a lot more about no landing. And Jeff, our morning brief today covered that disconnect between what we saw with strong earnings and what we're seeing here. What is your take on this?
Well, we've had a lot of narratives this year. It started off as a recession was a foregone conclusion. Then it was soft landing. Now the Fed's behind the curve. So things have changed rapidly over the last month and a half. But in thinking about market price action, it's really been driven by sentiment, right? The fundamental picture from the earnings backdrop that we got has not been pretty, right? The number of companies beating expectations is about 70%, well below that 5-year average. The year-over-year earnings print expectations just moved into negative territory. The last 4 times that you've seen this dynamic take place, you've really seen an acceleration to the downside for equities, and you've seen broad-based margin deterioration with operating earnings down about 150 basis points, and that's usually recessionary territory. So while the markets have hung in there over the course of the last 2 months and through this earnings season, I think when reality ultimately comes to bite, which is a U.S. recession in the back half of this year, I think the markets are going to price that, but we haven't seen it quite yet.
And as we talk about some of these signals, we know that your recession risk dashboard focuses on housing permits as one of the indicators. What is that signaling right now?
Well, housing permits just went to a red signal. So we have 12 economic signals in our proprietary dashboard. At the moment, we now have 9 red signals, but this turned to an overall red signal back in August. So our base case has been a recession for over half a year. And given all the rate hikes that the Fed has done and will continue to do this year, we think a recession is a very strong possibility. And I know that we got the LEI numbers this morning and the markets rallied after getting it. But the LEIs are down for the 11th consecutive month, right? Usually when you go down 4 months in a row, you're in that recessionary danger zone. Clearly through that threshold and looking at it from a different vantage point, the LEIs are down 5.9% on a year-over-year basis. The largest drop that you saw prior to a recession was 5.7% ahead of 1980s downturn. So even with this, a reacceleration of activity that we're seeing, we think that the economic cake is baked for the U.S. economy, and the more hikes that we're seeing now is going to deepen the inevitable downturn that we're anticipating.
And speaking of hikes, I know that you said that you're expecting the threat of interest rate hikes to be relatively muted when it comes to mortgage rates. We did see them climb higher consecutively over the past 2 weeks to 6.32%, and that came off the heels of 4 weeks of declines. But why are you expecting it to be relatively muted?
Well, I think a lot of the pain has already been felt in the mortgage market. You've obviously seen an impulse of positive housing activity with the NAHB bouncing this week pretty considerably to 42. Mortgage applications bounced as well. But I think more importantly, you have a housing market that's in a much better position than what we saw just 15 years ago, right? You don't have people who are overextended. A vast majority of mortgages that have been originated here recently are super prime borrowers, not subprime. And I think when you think about the mortgage market overall, it's not uncommon to see a bounce as you get towards the end of a tightening cycle. So if the Fed does another 50 or 75 basis points of tightening, that's already reflected in mortgage rates at the moment. And clearly what we're seeing right now is that there's a little bit of pent-up demand for housing, which is why we've seen the bounce here.
And also want to talk layoffs, because obviously we have seen layoffs mostly still concentrated in the tech sector, not really seeing that as much in the broader economy. But we are continuing to see these announcements. And you're saying that we should be having a look at the home builder sentiment as perhaps a foresight of what we can expect in terms of layoffs for 2023. What is that showing you?
Yeah, so obviously a lot of the layoffs have been larger companies, big tech in particular, but I think a lot of people forget that these companies have been feasting at the trough of labor over the last couple of years. Really, if you look at all of the excess labor demand, it's coming from small businesses. The increase of job openings today versus prior to the pandemic, about 90% of them have been from companies that have less than 250 employees, even though they only make up 45% of the labor share. So this is really a small business story. But if you think about looking out over the next 6 to 9 months, the ability to raise prices is dropping dramatically per the NFIB Small Business Survey, and the number of companies looking to raise compensation is remaining steady. So there's being margin pressure being illustrated in small businesses, and we think it's only a matter of time before that results to a full-scale layoff cycle. Now, coming back to your question, how does the NAHB survey from home builders relate to the unemployment rate? It usually leads the unemployment rate by 12 months, and even though we have seen a bounce in the NAHB, this would suggest an unemployment rate, if this relationship holds true, north of 6% if we look out on the horizon.
Certainly worth keeping in mind, because we're not hearing too many people talking about that. Jeff Schulze, thank you so much. Investment strategist at Clearbridge Investments. Thank you for your time this morning. All right, coming up, we take a look at the 2023 tax season with a former IRS commissioner. Stay tuned. China has issued its biggest ever cash injection for the economy as it looks to stabilize amid the rocky COVID reopening and ongoing geopolitical tensions with the United States. So if you're an investor looking at China-based companies trading in the US, what's the outlook? Yahoo Finance's Inez Ferre has the details. Inez, what are you watching?
Yeah, Rochelle, well, China's central bank has been adding liquidity into its financial system. In fact, it's been doing this through what are called reverse repos. So what are those? Those are basically short-term loans to banks. And it recently added $121 billion. That's its biggest one-day action on record. And this is important because this is in order to keep loans going. It's in order to sort of grease the wheels of the economy as China's economy reopens. And the whole liquidity issue has been important recently because Bank of Japan recently bought a record amount of bonds in January, and that helped with liquidity in the worldwide system because you have a note from Citi talking about $1 trillion that's been added into the global system in the last few months. And $1 trillion swing can be up about around 10% swing for stocks, so that can mean a 10% downfall for stocks depending on which way that goes. And so if you take a look at a year-to-date chart for the S&P 500, by the way, that January spike that we saw, that rally that we saw in the markets, part of that, economists have been attributing this to that increase in liquidity in the markets because of China, because of the Bank of Japan. But let's get to Chinese stocks because that's what we're talking about right now and what the impact that these have had. Now, today you are seeing pressure on these Chinese names. You also are looking at pressure on technology stocks as a whole. So these are following suit as well. But if you take a look at a year-to-date chart, you can see some of the gains for these Chinese ADRs. And if you look at a 2-month chart and even a 3-month chart, you can see the rally that these Chinese ADRs have had. Well, some analysts are now saying that there was some low-hanging fruit that was taken. And if you didn't buy into that rally or when that rally was just starting, you probably missed the boat for now because the next leg up for these Chinese ADRs is really going to be slow and gradual, perhaps, because you had this rally as this change of policy was taking place where China ended its COVID-19 lockdowns and it was reopening the economy. That was a big change in policy. That sent stocks higher. So now it's a wait and see for the next leg up for these, because as you mentioned, there are tensions going on with the US and China when it comes to semiconductors. The Chinese housing market is still depressed as well. So it's a wait and see game. Rochelle?
Indeed. Great stuff there. Inez Ferre there for us. All right. Well, President Biden's nominee for IRS commissioner answered questions during a Senate Finance Committee hearing this week, highlighting key objectives he plans to focus on if nominated to lead the IRS. Take a listen.
If I am fortunate enough to be confirmed, the audit and compliance priorities will be focused on enhancing IRS's capabilities to ensure that America's highest earners comply with applicable tax laws. Also front and center will be efforts to modernize and dramatically improve taxpayer service.
And with the 2023 tax season already in session, here's what our next guest says should be the focus of the IRS as it makes its way forward from the impacts of the pandemic. Joining us now is former IRS Commissioner Charles Rossotti. Charles, thank you for joining us this morning. What is your take on the priorities that Werfel is laying out here in terms of the wealthiest taxpayers and really modernizing the IRS as well?
So, I mean, what Werfel said, you can say it in a lot of different ways, but there's basically two main things that the IRS is supposed to do. One is it's supposed to help the average taxpayer comply, meaning file your return. If you have a problem, answer the phones or otherwise resolve the issue. That's called service in general, but it's just basically anytime anybody has to interact with the IRS, make it as easy as possible. That's what he said. And the second one is make sure everybody complies with the law. He focused on upper income people because that's where a lot of the lost revenue is. So, I mean, no matter how you phrase it, those are just logically the two main things that the IRS has to do. And there's a lot to making that happen, but it's not that hard to understand where you're trying to go.
And we know that he was also grilled on how he'd spend that $80 billion in extra funding that was approved as part of the Inflation Reduction Act. A lot of misperceptions came out when this, of course, was announced. But in terms of what should be prioritized with the funding within the IRS, what would you say?
So I think that it carries directly from the two main things that he said need to be done: improve service and make sure everybody's paying what they owe, especially the upper income. So the first priority, really, in terms of timing, really is to fix the service issues, because they have deteriorated very, very badly, as probably any of your listeners know, if they've had to deal with the IRS. I mean, for most people, if they just file a return and it goes smoothly, they get a refund, there's nothing to it. But, you know, with 150 or 200 million things being filed, some of those are going to have a question or return. And when you try to deal with the IRS in any way, it's been very, very poor. A lot of that was made worse by the pandemic and the additional responsibilities the IRS was given. So it has a backlog as well. But even over an earlier period, it's been very, very poor. So the first thing he has to do, I mean, in terms of timing, is fix that. And that won't happen immediately, but it can be done sooner. And a lot of that has to do with hiring trained people, but a lot of it also has to do with improving some of the technology so that the IRS can get up to the kind of experience that most of your listeners are used to when they deal with any financial institution or other kind of service provider. So that's first. And then it's going to take a little bit longer, but the IRS has to update its ability to find where the missing income is efficiently using technology and to train people to follow up when necessary. It's not an across-the-board approach, as sometimes was, I think, misleadingly said, you know, hire thousands of agents and just go out and audit everybody. That makes no sense whatsoever. The IRS has never done that. And even with the additional money that's been provided, the IRS is never going to have even as many agents as it had when I was commissioner 25 years ago, believe it or not. So the only way to do that efficiently is to be very precise and targeted, and you need technology to do that. So on the compliance side, it's not a matter of blanket auditing everybody. It's just the opposite. It's got to be very selective, and you need technology to do that, as well as trained people.
And what about the relationship between the IRS and Congress? We know obviously there was a lot of pushback from the GOP about this, but we did see at least some support for Werfel during these hearings. How important is it that to manage that relationship?
So I said, you know, if I were advising the new commissioner, I'd say there are three top priorities in the beginning for him personally. And number one among those is establishing those relationships with Congress, as well as other stakeholders, because there's many. But building those relationships is key, because there's a day-to-day communication that needs to take place. I was very encouraged by the hearing. It was very respectful, as far as I know. I didn't see it, but I heard about it. And I think he was very adept at, you know, doing what he should, which is to promise to be open and honest and communicate. And if there's issues that come up, to deal with them. So that's almost, I would say, the top thing for the commissioner to do. Internally, he has to then set priorities in order to follow through and execute on the things that he promises. And he has to hire a team or put in place a team that can help him do that. And that's, you know, that's at a top level what needs to be done. But it can be done. I mean, when I was commissioner a long time ago, you know, it was also very contentious, as it is sometimes. But over time, if you work with the senators and are really willing to be honest with them, I think most of them are willing to give you a shot at it. And I think Werfel did a great job on Wednesday getting that started.
And of course, as people prepare to file their taxes, if they haven't already, a lot of people wondering about the backlogs. How far are we to really getting that squared away at the moment?
Well, I don't know. I'm not internal to the IRS, so I don't know the details. But I do know that they've made some progress, and I think that you know, the priority has clearly been established of clearing up that backlog. It's unfortunate that it's accumulated to that extent, so it's going to take some time. But I think everyone there, even before the new commissioner got in place, understood that's got to be the first priority. So I can't give you a time because I'm not inside, but I do know that they're intensely focused on it.
I'm sure that's welcome news. And I do appreciate you joining us with your insights. A big thank you there to former IRS Commissioner Charles Rizzotti. Thank you for your time. All right, coming up, Deere is raising its outlook, showing increased demand for spending for construction customers. We'll do a deeper dive into the numbers with an analyst from Stifel next. Deere & Company shares pushing higher after a beat on the top and bottom line in its latest quarter as the company raises its annual profit forecast. Here to discuss is Stanley Elliott, Stifel Machinery and Construction Materials Analyst. Good to have you on the show here. So I want to get your takeaways. You obviously have a buy rating on the stock, a price target there of $402.96. What were your biggest takeaways from this report?
Yeah, I mean, looking at the momentum that they're seeing right now, as you mentioned, both the top and the bottom line beat. You think about what's happening across the overall landscape. Many of the markets that we're seeing in some of the earnings reporting so far really have not been this robust. And there's a lot of things contributing, we think, to Deere's outlook for this year, and we think that can continue into the coming year. You know, you think about the business with the precision production ag part of the market, the large ag professional farmer, we still see that as an opportunity for them to adopt technologies, as well as the fleet within the industry is still rather aged.
And I want to ask you, because they also did, of course, raise their net income to a range of $8.75 billion to $9.25 billion for fiscal 2023. How optimistic are you that they can reach that?
Yeah, you know, right now you've got a lot of tailwinds for the business. I mean, you're talking about double-digit pricing across all of the businesses. You're talking about a supply chain that's starting to improve. You know, if you go back to last year when inflation was as rampant as it has been, the company faced over $2 billion of incremental costs. Those should be winding down. That should be another tailwind. And then within their order book, they exited kind of fiscal 22 with about $20 billion in orders. Right now, the order books that they have are extending into the fourth quarter. Some of it will take inquiries even into 2024. So we think that the outlook is fairly solid right now. I guess the one caveat would be if we do see a disruption or further disruption in the supply chain, then that would put pressure on those results.
And we know a lot of people were wondering what that means in terms of the crop prices. Obviously, we saw the impact of that with Russia's invasion of Ukraine. And so how does that play into the outlook, though?
Yeah, no, certainly crop prices are important, right? And, you know, within that, though, you know, the net crop, net farmer income is expected to be down, but we're still at elevated age levels relative to history. We'd also add that fleet ages are fairly aged in our estimate. You go back to the prior crop cycle and machinery peaked really in kind of 2013, 2014 period of time. We had a number of years where we were producing below what we would consider an average use for the machinery. We're just starting to get to that level. And then you layer on inventory at the dealer level is exceptionally lean. So all of those things should support demand levels into 24 would be our guess.
And how would you say Deere stacks up against rivals like Caterpillar in this sort of environment?
Yeah, you know, it's the farm economy we think is a little bit more conducive, right? A lot of the machines are built to order. There's a finite, period of time when everybody is planting and harvesting all at the same time. Within that, they've also been able to adopt technology and been a faster adopter of technology. And when you look at what Deere has done, presenting at the Consumer Electronics Show the past 3 years, it's really highlighting what they're doing, what we think on terms of how they're trying to push that technology. They had an analyst day mid last year where they're identifying about 150 billion of incremental opportunities above and beyond the traditional machinery spend as you move into helping with farmers with labor, helping cut down on inputs, helping to save costs all along up and down the value chain. And we think that those are interesting characteristics.
And we know also currency headwinds that had played a role for a lot of companies does seem to be easing for Deere. Do you expect that to continue? Obviously, we're not quite sure what's going to happen with China's reopening and the pace of it as well.
Yeah, a little bit hard to say, right? I mean, they did take down their the FX headwinds within that. But no, look, corn, soybeans, they're all global commodities priced in the U.S. dollars, and so we'll continue to watch that. But whether it's China reopening or other opportunities, weather issues, drought, et cetera, it does have a bearing on what's going to happen with the commodity market.
We'll certainly be keeping an eye on that. We do thank you for joining us. Stanley Elliott, Stifel Machinery and Construction Materials Analyst. Thank you for your time today. All right, coming up, what's the impact of high inflation and recession talk on business leaders in the grocery space? We'll speak with billionaire John Catsimatidis next. Inflation continues to weigh on the economy, with the Department of Labor reporting the cost for goods and food producers remains high. Now, those prices affecting everything from groceries to rent. For more on the rising cost of goods, let's get to Red Apple Group CEO John Catsimatidis. Thank you so much for joining us. And a note that Catsimatidis is also out with a new book called How Far Do You Want to Go?, set to launch on February 28th. So obviously very busy. So we'll start, of course, with groceries and what we saw with inflation data there. We saw 11.3% higher for grocery prices in January than the year before. How are you managing these costs? We know that some grocers are passing it on to consumers, and others, like Walmart and Whole Foods, according to the Wall Street Journal, are asking suppliers to lower their prices.
Well, I've been a CEO for over 50 years, and the reason I wrote the book is because I want other people to realize all the complexities of being a CEO for so long. How do you manage? You try to stay ahead of the curve. When prices are going up, if you don't stay ahead of the curve, you're going to get hurt. And CEOs, most CEOs know it. The ones that are not smart enough don't know it, and they end up losing. And again, common sense, which I named one of the things in the book, is the fact that make sure common sense prevails. What happened when oil went through the roof? That's what caused all the inflation to happen in food. Now, there's a conflict in the world. The conflict in the world is the Russians want high crude prices. OPEC, Saudi Arabia want high food prices, oil prices. What happens? If oil goes up, then food goes up. If oil stabilizes, then food will eventually go down, other expenses will go down, et cetera, et cetera. And the way America wins, right now in America, in the last 2 years, because of all the crises going on, we moved trillions of dollars of wealth from North America to elsewhere in the world. And this is the problem we're having. America wants $70 oil. Guess what? This morning, oil went down almost $3 a barrel. And if it keeps going down, and if the Fed stabilizes, then you're going to have the end of inflation. The Russians don't want that. The OPEC nations, they want $100 oil. They don't want that.
So, John,
what are we going to do?
So, John, I know that you focus on really, common sense and instinct, especially that's something that you highlight in your book. So then how are you evaluating the opportunities in this sort of environment?
Well, you have to evaluate. Right now, real estate prices are in the toilet. They're going straight down. Why? Who's going to pay 6%, 7% for a 30-year mortgage? Who's going to pay, who's going to pay those rates? Nobody. Construction loans. Who's going to pay 8% for a construction loan? Nobody. So right now, 20% of the industry, real estate is 20% of the industry of our country. We're destroying that. How do you fix a problem by just creating a new problem? It doesn't work. Common sense. Fix the problem that created the problem, which is let's make sure oil is $65, $70 a barrel, and everything else will go away, and interest rates should come down following that.
And John, I know that with Red Apple Group, you're pretty diversified here. You have holdings in energy, aviation, retail, and real estate. How are you balancing your portfolio at the moment?
Well, that's why I'm able to make correct projections, because we're in all those things. And it is difficult, but like I said, I'm a CEO for 50 years. Stay ahead of the curve. If we don't stay ahead of the curve, and that's what I tell about in my book. If you're a young CEO, I try to teach them, how are you going to make $1 billion too? And I understand Amazon was the #1 business book last night on Amazon. So, how do you make? We want you to make $1 billion too.
Oh, I do quickly just want to ask you, obviously, the American dream has shifted a lot, from when a lot of us were kids. What do you think it looks like now, and how hard or easy is it now to achieve?
There's a clash in our country between entrepreneurs that want to have the American dream, that want to work 100 hours a week, 90 hours a week to create the American dream, versus the people that don't want to do that. So there's a clash in our country for the first time in that particular situation. And America has to decide, for whom does America stand for? Does it stand for growth, entrepreneurship, or does it stand for the woke culture? That's bottom line.
And I do, of course, want to ask you, we have the 2024 presidential elections beginning to shape up, attention turning to names like Nikki Haley, Mike Pence, former President Trump, as the 2024 presidential race is drawing near. A change in leadership could have obviously big impacts on the legislations facing regional and mid-sized businesses. So let's return to how business regulation and politics could shape up. We're going to continue this conversation now with you, John, here. So, you've donated to both Republicans and Democrats. How are you deciding this right now, and what are you prioritizing? What's important to you this election season?
I love Bill Clinton. I was a Clinton Democrat. I loved him. I thought he made common sense decisions. So on my radio show that I have is I believe in common sense Democrats, common sense Republicans. I try to interact them at our 5 o'clock show and say, okay, let's argue. Let's scream at each other. Let's try to come to common sense solutions. But you know what we do at 6 o'clock? We all hug each other, just like the old-fashioned way of arguing during the day, like Tip O'Neill did with Ronald Reagan, like Bill Clinton did with Newt Gingrich. We just want everybody to work together for a better America. And that's what we stand for, a better America. Because right now, my only concern with President Biden is I think he's a little bit too soft on China. And that's my personal concern.
Now, obviously, I want to talk about some of these front runners here. What do you think of the crowd for the GOP right now? Obviously, you have Nikki Haley most recently, but obviously you have Ron DeSantis and former President Trump also throwing his name in. When you look at how you would like perhaps the economy or the business environment to go, who do you think would be in a better position?
I thought President Trump could have been another Ronald Reagan, right? But his problem was he made new enemies every day. And this is what I write in my book is I want to make new friends every day. And the success entrepreneur makes new friends every day instead of making new enemies every day. And I think Nikki Haley might make a great vice president. I don't see her in the #1 spot.
Oh, I was going to ask you about your presidential aspirations. I know you tried your hat at perhaps the mayoral race. Any idea of perhaps at some point you might run for president?
Well, you know something, everybody wants to be president when they grow up. Unfortunately, I'm an immigrant. I came here when I was 6 months old. Even though my grandfathers came in 1913, I'm an immigrant. I can't run for president unless me and Schwarzenegger get an exemption.
If anyone can, I'm sure you can. A big thank you there to Red Apple Group CEO John Catsimatidis. Thank you for joining us. And of course, John's newest book, How Far Do You Want to Go?, out on February 28th. Thanks so much. All right, coming up, how much money are your favorite influencers making? We'll break that down next. time now for our chart of the day, and we're checking in on the freelancer labor market as the proportion of freelance workers across the country has reached its highest since 2014. According to Upwork's 2022 Freelance Forward Survey, the sector as a whole continued to grow last year. Compared to 2021, an additional 3% of the US workforce did some form of freelance work this past year, for a total of approximately 60 million Americans. Well, in 2022, freelancers contributed $1.35 trillion to the U.S. economy in annual earnings, up $50 billion from 2021, with over half of all freelancers providing knowledge services, such as computer programming, marketing, IT, and business consulting. Well, all I need is your like. Becoming a full-time influencer may be the dream for some of Gen Z, but just how much content does an influencer need to publish to make a living? Joining us with more is Yahoo Finance's Kelsey Barberio. Good to see you, Kelsey. So obviously there's this outsized influence that everyone thinks, all these influencers, especially on TikTok, are making so much money. But what's the reality? What is the share of really these TikTokers making the most money when you think of the content they have to create?
So in terms of influencers, obviously, yes, they are making so much money. That is the headline there. They're making a ton of money, but most of it is not coming from the creator fund. TikTok has this creator fund that pays them out. I think it's between 2 and 4 cents per 1,000 views. So honestly, if you're getting like 1 million views, you're looking at $20 to $40 for that 1 million views. That's really hardly anything. And so for some of these larger scale influencers, like Alex Earl, she's very popular on TikTok these days. She's looking at about roughly, last week she got about 115 million views, and she posted 36 videos to get to that point. That brings her to about $180,000 a year just on the TikTok Creator Fund. But she's also absolutely the anomaly. She is not the normal one here. And aside from her, we've got Meredith Duxbury. She's popular for her makeup content on TikTok. She had 65.3 million views last week. Again, so hard to get to that point. She is, again, probably the top 1%. She's probably making about $102,000 a year, but she posted about half as many videos as Alex Earl did. She posted 18 compared to her 36 last week. That's a lot of content as somebody who creates content for Yahoo every day.
So is there much of an incentive then to go the creative fund route versus, say, another route?
So of course, we've got the creator fund. I think that there is still an incentive. Nobody's gonna, if you're making that much money off of it, you can, even if you're making $100 a month, I feel like it's still kind of worth your time. But most of the money that these people are getting is going to be from those brand partnerships, whether that's a L'Oreal contract or other large brands. Those are the things that are going to be paying them, $50,000 a post. So that's where the real money is. But for the most part, I don't know how much of their content is monetized. Some people, I think, do a bit more than others.
I mean, obviously, YouTube is like the OG when it comes to, influencers and how they get their voices out there. You get the longer form as well. When you compare some of these platforms, then where, perhaps, if you're just starting, are you more likely to make more money? You've got YouTube, Instagram, TikTok. How should people navigate this?
YouTube's their creator program has a lot more financial benefit to it, I would say, at this point. And I know that at the start of this year, they rolled out some new YouTube Shorts components to their financing that are making it really lucrative to be over there. So I think that a lot of people, all these other accounts, they're trying to bring people in. I know Reels does different bonuses for Instagram. I think TikTok is still one of the easiest platforms to become a viral sensation on. I think the way that the algorithm works, it makes the most sense for somebody who's maybe starting from the bottom. But if you've been a YouTube influencer for a long time, you might want to stick with YouTube. They pay out really well from what I hear.
I mean, and we saw, especially during the Super Bowl, TikTok went all out and they're sort of combining things like, being able to sort of just click and pay as soon as you see something. Everyone's, like, TikTok made me buy this. Is that something that we're going to continue to see? And is that very lucrative for a lot of these influencers?
I think so. I think that there's the TikTok shopping is a new thing that they're trying to make happen. There are other programs that they've kind of had in the past. They've tried to run partnerships directly through TikTok, and I can't say how successful that's really been. In fact, I think it hasn't ultimately been that successful as of now. But I think that shopping on TikTok is a thing that they really, really want to make happen. Although I think they're kind of missing out then at that point on that kind of personal element that you get usually when you're watching your favorite influencer. People like it because it feels true to them. Like, it feels like, oh, this is my friend telling me to go buy this mascara, so I want to go buy this mascara. And I think if it's veiled behind a shopping network, it might feel a little bit different.
It's true. You do sometimes see that pop up in the comments. People are like, stop trying to sell me stuff. I'm just interested in the content. Great stuff there. Yahoo Finance's Kelsey Barberio. Thanks so much. All right, well, concerns are mounting over Netflix's password sharing crackdown. We'll explain next. More and more Netflix users are expressing their concerns and their confusion over the streamer's crackdown on password sharing. Yahoo Finance's Alexandra Canal has the details. We know there's been a lot of back and forth online about this.
Yes, Rochelle, and I've received dozens of messages from concerned Netflix users. Netflix has said that what's been released so far in regards to the password sharing crackdown is only applicable to the announced countries. So remember that nothing has happened in the U.S. just yet, but countries like Canada, Spain, Portugal, Costa Rica, among others, are currently in the midst of this crackdown. So here are some of the biggest concerns from our viewers and readers. Jeff K. writing, quote, "I understand Netflix's desire to stop 5 friends that don't live together sharing one account login, but that is how they built their business. Families with children away at university would be considered part of the household under the Stats Can definition, since their primary residence is still with their parents." Now, that is not necessarily true, because Netflix defines a household as those that actually live within it. So that could be roommates, it could be a family, but if you have kids that are studying at college that are away from that primary residence, under the terms of Netflix's rules in Canada, where this viewer is from, that child would have to pay for a separate account, or the primary account holder could add up to 2 outside members for an extra $7.99 Canadian dollars a month per person. Another concern here came from Eric W. He wrote, quote, "I stay at 3 other locations besides my home each month. This Netflix agreement is reducing my livelihood and subjecting me to hardship. Netflix has made new agreements with actors and film production companies and piggybacking on consumers to pay for their deals through these agreements." Now, if you are a snowbird and have multiple homes, you can in fact change your primary location through the Netflix app, so that is not an issue. You could also travel and watch Netflix from your hotel with particular access codes. So it seems like Netflix does not want to make it harder for the actual account holder to access their subscription. And then finally, one more point here from Amanda G. She wrote to me, quote, "If the policy change makes it that we would have to pay full price for a subscription, we would not add the service. The reality is each subscription service provides limited options happens at this point. And frankly, I believe people will be returning to illegal downloads. Netflix was a draw because it meant we could get rid of our overpriced cable service. At this point, by needing multiple streaming services, it will end up as being as expensive as cable. She understands that the business wants to make a profit, but she does believe that at the end of the day, this is going to be a net negative. And this has been a continuous concern among subscribers, given how many services are currently on the market. So a lot of questions right now, very few answers, but definitely something to keep an eye on as we get closer and closer to that crackdown in the US.
It'll be interesting to see how Netflix reacts to the results that they've seen in the backlash already before it even gets to the US, to see if they make any changes or if they just go ahead and roll out with this. But a lot of people still have questions. And thank you for answering all of those for us there. Ali Canal, thanks so much. Right, well, before we go, let's do a final check of the markets. We see all three major indices still in negative territory, off the lows of the day, though, as we head into the noon hour. We see the Dow there down about 1/3%, down 95 points. The S&P 500 down about 1%. The tech-heavy Nasdaq there down about 1 1/3% there, dragged down by the FANG stocks and also Nvidia. Well, that does it for now. I'm Rochelle Akufo. Have a wonderful weekend. I'll see you Monday at 11 a.m. Eastern.